maybe some new things you've learned. I believe there are a lot of people here on the call that's already good at financial modeling. And of course, this is an advanced class as far as modeling is concerned. If you can just type in the comments box what you enjoyed in last week's session and what you look out for in this particular session. So if you can do that, if you can type that quickly in the chat box. Started, but yeah, it's revenue modeling. Okay. Bavia, I see you there. Last week was a great time. And I hope to have more intense engagement today. Last week was quite great. And also, Akofa said, I enjoy the questions, understanding people's thoughts, processes. Victor, most especially Kiga, and Uchi said it was a practical interactive session. And of course, you guys made it happen, the practical, the interactive aspect of the lecture. So we expect more today. And the other revenue modeling aspect, especially for the bank revenue stream. Oh, okay, great. That's from Yusuf. And then your model is as strong as your underlying assumptions. Yes, Daniel, that's true. I got that. And revenue analysis. So from Isaac, whose name I have not mentioned, at least. I believe I've mentioned everyone's name. Everyone that has typed in something, I've mentioned the names. All right. So the objective at the end of the day is to come up with projected P&L accounts, a balance sheet, and a cash flow statements. And I mentioned that because this is an advanced class, the approach is a bit different. We're going to spend so much time on the assumption side. And then next week, we'll get into analysis side in terms of doing more in Excel. But again, I'm going to go beyond just financial statement, right? We do some cash flow analysis, cash flow risk assessments, and we also handle some things relating to scenario analysis and simulation techniques. As far as cash flow planning is concerned, mentioned that we're going to get into that, get into free cash flows and all that as well. Just that we're not going to be covering valuation, of course. That's not the purpose of today's class. And okay, more statements, more comments coming in. But then I want to move straight to the business for today. What I'm going to say is that given that we are done with revenue, the other thing left on the P&L is the cost. So we're going to cover cost. Once we're done covering cost, we are jumping straight into the balance sheet. And today, we're going to be dealing on the balance sheet matters. We deal with working capital, forecasting, and then we also deal with debt modeling. You see, debt is a big thing. It's a big thing. So I want to quickly run through the cost and working capital, even though I'm not going to rush it, but then so that I'll be able to cover the lecture on the debt modeling aspect. There are several parts of debt modeling, but then the concentration in this program is not project finance. Otherwise, more will be done is on more of corporate finance. Maybe a little bit of project finance. Okay. But then you handle some complexities in debt modeling today as well. Great. Hope you're ready to start with me. Let's get into the agenda for today. And again, just as I always do, okay, just as I always do, I want to issue this disclaimer that the case studies and accompanying references may be third-party information. I'm ready to start with me. I think there is someone, okay. So the case studies and accompanying references made to third-party information are entirely fictitious and should not be taken as factual information, even though a reflection of reality. In addition, the content of this presentation are my professional judgment on the subject and not that of my employer or the CFA Institute or the CFA Society in Ghana. Just to set that straight. All right, now, so in this particular session, we are going to handle cost modeling and also working capital modeling. Let's get into it. So for the cost modeling, there are 3 learning outcome statements we're going to be covering. The first one is understanding the key sources of data for modeling costs. And the second is evaluating the key considerations in modeling costs. And then the last one would be forecast costs for diverse entities. So we're going to look at how to forecast costs for few entities. Of course, the learning outcome statement may not be grouped in maybe, or the lectures themselves may not be grouped in that sequential order, addressing the outcomes. It's kind of like we may be treating the first one, maybe somewhere, whatever, just balance like that. But then the things we studied under revenue and the historical analysis last week, we are going to be applying similar things. So the first thing, let's look at cost of sales analysis and modeling. How do we analyze cost of sales and model it? When we're dealing with the historical analysis, we covered the issue of the cost structure of an organization, the typical cost structure of an organization. And then we talk about costs being analyzed by elements, by nature, behavior, and by function. And by elements, we talked about the cost being either material, labor, or expense related. By nature, we talked about whether it's direct or indirect. So the nature is a matter of how related is the cost to the product or service you sell, which we call the cost unit, what you actually sell, the final outcome you sell. So for example, I made mention of, let's say, a university. If we take a university, for instance, and we want to get to understand the cost classification by nature, it's a matter of the cost associated or directly associated with the students or faculty-related costs, if we should put it in that way. And then when we talk about behavior, it's about the relationship between cost and maybe volume or output or the level of activity. And so in that case, cost can be fixed, meaning the relationship is not quite there. And in that, even when output limits or levels change, the cost will remain the same. But then I explained this yesterday, that is to say that the cost is fixed over an output range. Beyond the output range, the cost then varies, right? We talked about variable costs, which of course is easy to understand. And then generally, the cost we see on the financial statement is more of a semi-variable cost. It has elements of both the fixed and the variable. And then we also talked about cost classification by function. And here we have production and non-production related. Now, these are standard tests. But the point is that the time management accounting is being developed, the world was dominated by manufacturing. And now things are shifting a bit. But then we still tend to use the same terminology. So you still see production, non-production related. But then if you pay critical attention to this, you realize that when we see production and non-production related, if you work in a service industry, it's more of the primary and the support service, right? So the primary activities, that's the mainstream work of the company. For example, in the university thing I talked about, I'm mentioning university because there's an example coming. In a university setting, the faculty sides are what we call the primary activity holders. And then the second, the support activities is more of the other unit support, like registry, finance, student services, and all that. They are, in this context, a non-production related cost, right? Great. And now let's take this example just to get a point home. Now, so the following is an extract from the audited financial statement of Priority University. For most services company, they love to refer to cost of sales as cost of revenue, right? Now, so this Priority University, an extract from the audited financial statement. So this is a breakdown of the cost of sales. Now, when you go to most companies' audited accounts, or the annual report, when you see the three statements, the P&L, the balance sheet, and the cash flow, the notes to the account usually have a breakdown of cost of sales or cost of revenue. Now, I mentioned this also last week that when we say financial statement covers both the three statements we know, the P&L, cash flow, and balance sheet. And also it covers the notes to the account. They are all part of the financial statement. So when we say financial statement, all that are part of financial statement. But I mentioned to you again that for the purpose of this lecture, whenever I talk about financial statement, I'm referring to the P&L, the cash flow, and the balance sheet. Now, so if you look at the cost items here, and below you see the student population, right? Now, and so the cost items between 2021 and 2023, you see faculty salaries and benefits, and you see student services, library and academic support, laboratory expenses, scholarships and financial aid, auxiliary services, information technology, building and grounds maintenance, utilities, depreciation of educational facilities, lecture materials, and others. Now, looking at this yourself, can you actually apply the cost classification framework to understand the movement in the components of the cost of sales for the university over the past 3 years? It's something you can do. For example, if you look at faculty salaries and benefits, it increased from 3,300 to 3,600, then to 3,900 year-on-year increment. But then you also see student population increasing. The question is this faculty salary benefit a variable cost? But then that is when we are dealing with classification by the behavior of cost. But then when we deal with classification by nature, we want to know whether the cost in question is a direct cost or an indirect cost. And so of course, if we deal with the university, the direct costs are usually the faculty related costs, right? They are more of the direct costs. So can we actually identify those costs that are faculty related and those that are non-faculty related? You see, there's a reason why we need to do this. When you want to forecast cost components, you need to understand how the cost changes as the level of activity changes, or as the student population in this context changes. That's when you know whether these costs behave this way. So can I forecast this cost just based on CAGR or inflation, general inflation in the economy, or can I forecast it based on maybe student population increasing, or if student population increases or our level of output or activity changes, will this cost also change in response to that? Those are the kind of questions you want to ask. So I want some comments on this in the comment box on the costs you consider direct and the ones you consider indirect. So let me get some comments from you. None so far. So in the next 2 minutes, I want to have some comments from you on this, on which costs are direct and those that are indirect, which cost elements. Yeah. I'm still waiting. I need some engagement here. Okay, so Grace says scholarship and financial aid is direct cost. Okay. Lecture materials, direct. That's from Daniel. Angela said indirect, other depreciations, building and grounds maintenance, auxiliary services. Yeah, that's true. Student services, direct. Student services, direct. Student service. Okay. Generally relating to the students and utility. Okay, so okay. All right. So I think I'm now having a lot here. Information technology, indirect, library and academic support, indirect, faculty salary benefit, direct, indirect, depreciation, utility services, auxiliary service, indirect, lecture material, faculty salary. Okay, good. Now, so this is what I want to say. You see the definition of what constitutes direct and indirect depend on how you're looking at things as well. Because if you are looking at things from the the investee level, the level of the investee, which you are getting right. Okay, Daniel has made some lists here. Now, when you look at things from the overall investee point of view, of course, some costs are clearly direct and those are indirect. But then sometimes when you get to, let's say for modeling of, or you want to model revenue and maybe cost for faculty or different faculties, so you want to separately do this model, you get to realize that within the faculty, there may be classification of what is a direct and what is an indirect too. Because you may be having faculty general administration course, which may not be allocated to a particular, maybe a particular class or something, or another division within the faculty unit. So it's a matter of where you are looking at things from. But then for now, we are looking at it from the level of the school. And I believe the answers you are actually giving over here are most of them are right. Good. I think we can move from here. Just to show you how you should be looking at course, and also in terms of the behavior of the course, and you can actually. But then before we move, if we are to do this classification by elements, that is into material, labor, and expenses, how do you think the classification will be like? For material, for labor, and expenses, which cost will be material cost? Which cost do you think will be labor? And which cost do you think will be expenses? Let me see how you looked at that as well before we move from here. So I'm still checking the charts to see. Material, lecture, yeah, Daniel, that's correct. Lecture materials, salary is labor, that's true. Okay, so faculty salary labor, great, from Yusuf, and Bavias is laboratory expenses labor. Really? Okay, you corrected that it's material. It all depends. I will actually classify that as an expense because I don't know what kind of laboratory test or whether materials may be involved in a test, labor costs may be involved in a test actually. So that cost can actually be a consolidation of all. Auxiliary expenses. Okay. Auxiliary expenses, expense, laboratory. Yeah, good. Okay, you got it. Okay. All right. At least for now, depreciation is an expense, Casey. So that's true. Okay, good. Thank you very much. Thank you very much for that. Now let's move to, I think if Naya said faculty salary is labor. Okay, good. Let's move to the next slide. And now we want to look at how we can forecast costs. Now, you see, there are two major methods or major approaches to cost forecasting. And this is what I want to say. If you work for a company, you have access to the GL, I mean the general ledger of the company, or management account. You have access to the detailed management account and things. You may prefer using a particular method. But if I'm outside a company and I don't have access to those items, I don't have access to the details of the company's cost structure, all I have is the financial statement, I may prefer an alternative method. Because in that case, because I don't have information, detailed information on a company's cost structure, I'm likely to just do the cost modeling at the level of the financial statement. Right. Now, so let's talk about the two methods here. Okay. Now we have the gross margin method, and also we have the build-up method. Now, the gross margin method is quite interesting. So now we know that gross margin is actually calculated by subtracting the cost of sales from sales. So if that is the case, then if we know gross margin, and let's say we can also project sales, then it's more likely that we are able to project what the cost of sales will be. Because gross margin is derived from sales and cost of sales. So by knowing gross margin, and let's say by knowing sales, I can get a cost of sales. Now, so forecasting cost of sales as a percentage of sales is equivalent to just forecasting gross margin percentage. Now, So what I'm trying to say here is that if we take cost of sales and express it as a percentage of sales, it gives us something we call the cost margin. Anytime we express something as a percentage of sales, we are getting something called margin in accounting, right? So cost of sales divided by sales can be called the cost margin, just as we have gross profit divided by sales being the gross profit margin. Okay. Now, so from there, we will be able to determine the proportion of the sales of the company that runs into cost of sales, or the proportion of the sales revenue that goes to cover the cost of sales. Now, if we see this historically and we realize that this is stable, then it means that we can base on that to project what cost of sales is likely to be. Now, the build-up method is different from the gross margin method. With the build-up method, you're actually going to get into the cost structure of the company. You look at what actually forms or what actually drives each of the cost items, the key cost items that form the cost of sales, like material costs, maybe labor-related costs, the product costs, and all that. So you're going to be doing some form of costing. So if it has to do with the product cost, you need to be able to calculate the cost of manufacturing, let's say, a unit of the product, and start it from there. But see, this requires some good understanding of management accounting. And you may not have the patience to do all that detailed cost analysis. You may rather prefer to do things at the level of the financial statement, especially if you are an analyst and you just want to you want to project this company's financial statement and use this as basis for valuation of the company's shares. You may prefer working with the financial statement rather than going to the company to get detailed information. All right. Now, so the build-up method also, there are two methods under it, or the activity-based costing method and the historical costing method. Now, let's deal with each of these methods. Now, what we do with the gross profit method, there are two ways we can approach it, or we can approach it from two or three main perspectives. But then I'll actually say two because the other one is a combination of the first two. So the first one is the historical gross margin. Now, because you have the financial statement over time, so you have the historical records of how the company's gross margin evolves. And we established that with the gross margin, we will be able to come out with the cost of sales. So if we're able to determine the historical gross margin, that is the first step to getting the cost of sales. So what we do, so this involves actually using a company's historical data on gross margin to estimate the cost of sales to sales ratio for the historical period. The cost of sales to sales ratio I mentioned earlier is the cost margin. So if we get a cost of sales to sales ratio, then we are good to go. Now, so the ratio actually represents the proportion of sales to revenue that is consumed by cost of sales, which I've talked about. And now there is actually, and many people, when they prepare their management account, they tend to consider the cost of sales as the direct cost. But then, in actual fact, cost of sales is not necessarily made up of only direct costs. It could be indirect costs related to production or rendering of the service in question. And therefore, but then when you look at it generally, the movement in cost of sales agrees or aligns with the movement in revenue to a large extent, right? So the trend in historical margin is analyzed to identify the patterns and fluctuations and the relationship between cost of sales and sales revenue. So after that, you then decide, based on your understanding of the market and economic environment, how you think that relationship will evolve over the forecast horizon. So now you establish a historical relationship between sales and cost of sales via the gross margin method. Then based on that historical relationship, you then ask questions. How do I think the future is going to be like? And use that as basis to adjust your historicals for the forecast period. The other side is to use the industry gross margin. You see, the industry gross margin gets much useful, especially if you're dealing with a new company, a company that doesn't have a past history, or sorry, it doesn't have a trading history, right? Now, with the industry gross margin too, you don't need to get all the players in the industry because most companies actually don't publish their financial statement. So at least a few you think that publish financial statement you can use. Another way to even gathering data around the industry is that you can use third-party sites like S&P 500, Capital IQ, or you can use Damodaran. Damodaran also he conducts some good industry analysis and get industry gross margins for multiple industries, in fact, across the entire world. So you can have that. In fact, I believe you can even drill it down to the African market alone for you to know the gross margin, the average gross margin of key players in the industry. In fact, that also helps in determining whether the company in question has a lower gross margin to the average company or a higher gross margin to the average company, and also help in setting target as to when we think we can reach that industry average gross margin. All right, so that is one thing you can do as well. Now, so the hybrid is a matter of combining the two. Now, I prefer the hybrid all the time. The reason why I prefer the hybrid is that I can start the historical gross margin analysis, and then I look at the industry, what the industry is giving me. I compare to what I've gotten from history. I ask myself, where do I think is my direction going forward? And then I see how to blend both. Well, I think going forward, I may be growing towards the industry, or I may be growing at the average of the history and the industry. Okay, any question? Other than that, I want us to take the first question. These questions are in your workbook, so let's get into your workbook. The first question there, under cost of sales modeling. So we have Yum Central Limited. So Yum Central Limited is a popular fast food chain located in Accra. It is known for its culinary delight and delightful dining experience. Over the past 5 years, the company has diligently tracked its financial performance, particularly its gross margins, as illustrated below. So these are the gross margins, the historical gross margins of the company. 45% in 2019, 47% in 2020, 46% in 2021, 44% in 2022, and 48% in 2023. Now, just before we continue reading this, I want you to put a comment, maybe express your concern about the historical gross margin. What's your observation? What concerns do you have? Even before we continue reading this, I want you to type that in the comment box. What concerns do you have? What's your observation here? Let me have some comments. Let me have some comments in there. Okay, so, well. If Naya said not stable, Justice says fluctuating, low variability by Uche. Okay, the gross profits fluctuate, gross margin decline in 2021 and 2022. Okay. Now, you see, well, I get it. You see, the difficulty involved in what I'm showing you is that if you have a competitor's gross margin history as well, aside this one, or put side by side, you can conclude on whether that of Yum Central is fluctuating significantly, or you think the fluctuation is fine, or you think it's stable. Now, one thing I'll ask you to do when you look at data like this, or one, is to determine the range. So what is the minimum gross margin and what is the maximum gross margin? Of course, the minimum is 44%. And for the maximum is 48%. So it means that gross margin over the last 5 years fluctuates between 44% and 48%. The question is this a stable gross margin, or you think it's a variable gross margin? Because one key task of management is managing this gross margin level so that it doesn't drop and it's also stable over time. There are more concerns here. They are doing better than industry. Okay, we'll get to industry decreasing, except, so that comment was from Rahel, and Sion said decreasing except for 2020. Daniel said it's above the industry average, so it's okay. And Mary said gross margin of Yum Central higher than industry averages and will likely get compressed in the future with competitors entering. Okay, let's get it into it now. So over the same period, the average gross margin for the fast food industry companies in the industry was 39%. Now, so looking forward, the fast food industry faces a fiercely competitive landscape with an influx of new buyers and disruptive trends. So this is a reason why I need to do competitor analysis, right? Innovative startups are redefining the industry norms with their new concepts, investing heavily in cutting-edge technology. Moreover, the industry is grappling with cost fluctuations, particularly in ingredient prices and labor expenses. There's a problem there, right? Now, so as Yum Central, so you see what is happening because you looked at the history, then you want to project the future. But if you want to project the future, you need to determine what is happening now and what is likely to happen. Will the future continue to, the past continue to project in the future? See, that's the reason why you need to do all this analysis. So you see how you can even adjust your cost, right? As Yum Central embarks on its 5-year financial forecast, the primary question emerges as a considerable challenge. Number one, so what will be the most appropriate gross margin to use for forecasting the cost of sales over the next 5 years? Now, let's address that question. So I want you to look at that for me. I want you to, and when you give the figure, please, try as much as possible and provide some basis. That is very, very important. Whenever you're developing assumptions for financial modeling, when you state the assumption that this is going as so and so, provide basis for your assumption. So the question is, what would be the most appropriate gross margin or gross margins? It may not be a single one to use for forecasting the COS over the next 5 years. So let me see some responses here. Okay, Victor was saying the decrease might be as a result of COVID. Okay, so average margin of 46%, average of the 5 years. That is from, but please, can you provide additional basis why you think going forward should be average? Rahel said an average of previous and recent year. Rahel, why? Why are you taking a previous and recent year, which is 2022 and 2023? So you're averaging just 44% and 48%. Why? Can you explain? Can you explain why? Okay, so Casey said, I will use a mean of 46%. Any reason? Any reason? Provide some basis. Provide some basis. Why do you intend to grow it at the mean? Why? Someone is asking for a link to the teaching material. I think Victor, you are referring to the workbook, right? Okay, Daniel, I may want to decrease the 2023 margin of 48% gradually towards the industry average because of the competitive landscape. That sounds great. That sounds great. From Daniel, that sounds great. The workbook. Okay, I think Ifrio will share the workbook. That was the one we used last week. Same workbook we used last week. Thank you, Ifrio. Daniel, that's a great one, right? So you see what Daniel have done? He has considered the competition. He has also considered the industry, not just looking at your historical averages. Yeah, those of you saying historical averages, it's not wrong. It's not a wrong answer. But then, can you provide a basis for that? Olayinka said, I might want to use the 39% industry average because of the competitive landscape and to be more cautious not to overstate gross margin. Now, this is the point, Olayinka. If you are into a transaction and you are advising on a transaction and you are on the side of the buyer, that would be a perfect thing to do. If you are valuing the business or you are projecting cash flows to value a business and you're on the side of the buyer, that's the perfect thing to do. But if you're on the side of the seller, I believe you won't do that. You would like to go with a more optimistic gross margin. Now, the same way, if you are looking for funding from a bank, you won't use 39%. industry average. But a bank that is validating your financial model may prefer to try industry average to see how the model responds to the industry average instead. Okay. Now, so should the company maintain the historical gross margin, strive for industry average margin, or adopt a transformative approach to seize opportunity and mitigate potential risks? Of course. So I want some comments on the second part of the question. I want some comments from you on the second part of the question. Let's do that quickly, guys. Some comments on the second part of the question. Where is going? All right, so Bhavya said, I think the gross margin will be higher over the years because the company is investing in technology, so they are likely to become more efficient over time, which may lead to lower costs and thus expansion of gross margin. Okay. Not that the company is investing in technology. What we have is that the industry players, now, so there are competitors entering the market with those advanced technologies instead. So maybe you read a question wrongly, so you may have to look at it. But then the point is this: if the company is to adopt a transformative approach, meaning the company should go ahead and make some investment in technology, of course, if that is the basis of what you're trying to say, that they should do that, and if you think if they do that, they can sustain the level of historical margins, then that makes some sense in there. All right, thank you. And Isaac says the company, let me read that of Isaac, the company should adopt a transformative approach to seize opportunities and mitigate the potential risks. Why? And what will be the impact on the margins, Isaac? Now, Rahel, the company should adopt a transformative approach considering the competitive environment they are operating in by investing in technology. Okay. All right. And the company should adopt, so this from Justice, the company should adopt a transformative approach to seize opportunity and mitigate potential risk. Okay. Okay. But then great responses. I love the engagement so far. I love this. And we got to sustain it, especially when we get to the debt side. The debt modeling sometimes could be a bit complicated, right? All right. Now, let's move away from gross margin and get into the historical costing method, which is part of the build-up method. Now, what I'm going to do here is this. For here, I'm not going to really, well, a lot of comments still coming in. Adopt a transformative approach, but Daniel said, I think they should strive for industry average because it's usually difficult to sustain higher margins above the industry in the long run. That sounds great. That sounds great. But this is the point. When you put all these assumptions, you should be able to document the basis for the assumptions. That's very, very important. Anytime you're developing assumptions, be able to document it, because you may forget why you think it should be average. Or if someone else is reviewing your work, the person should be able to understand the basis of your conclusion. Isaac, as the competition becomes fierce and other companies invest in technology, they are likely to have cost advantage, and that can have a disastrous impact on the margin. That's true. That's true. Angela said gross margin has been within the same range over the same period. Spike in 2023 can be attributed to high inflationary environment and subsequent increases in cost of input month on month. I will maintain 48% in 2024 and 2025 and use an average of 45% for the subsequent years as the company invests in technology to help manage costs and remain competitive within the market. Wow. This is quite lively, trust me. And I like the points that you are not just maintaining a single point, maybe margin over the forecast period, but then you are considering the implication of the investment. Because if you are making technological investment, you don't expect it to maybe take effect right from the point, right from the word go. So that is correct. One thing I can also say is that when you deal with companies like this, let me go back to the previous slide. One thing I always do is that, because these are historical figures, right? I will look at the current year as well, look at the current trading. What has been the gross margin so far for just this year. So I have to look into the management account. But that is if I have access to the company's financials or management accounts and all that. And I'm doing this for the company or within the company. I look at the current trading. And last week we talked about what current trading is. I look at the current trading analysis, look at so far what has been their the percentage completion of revenue. So the projected revenue that they want to earn 1 million revenue. We are 4 months into the year. So what has been the percentage completion? Are we on track? So when it comes to gross margin, I want to know the percentage completion. It will give me an idea of whether they are going to achieve the gross margin they just achieved in the last year, right? The 48%, which is quite significant. Good. But then one key thing you have to also do is that you need to talk to the company. That is if you have access. Why did you have a gross margin of 48% last year? What went well? What went on well? Why not 2022? Do you see yourself maintaining a gross margin? Of course, that one, there's an obvious answer, and that is we see ourselves. And then you have to judge the rest. All right, so build-up approach here, again, historical costing method. And now, so here we want to determine the cost from scratch, right? We want to build up the cost. So if it comes to something like, let's say product cost, we need to ask ourselves, what are the various elements of the product? What costs are incurred directly or indirectly to get the product produced? So we come up with all those costs. Some of the costs may be volume driven, some may not be volume driven. And so we are looking at the costs associated with raw material, direct labor, manufacturing overheads, and all that. So we need to do a data collection. We need to collect all this data, and we need to identify those and classify the cost components accordingly. That's why we looked at cost classification. So classification by nature, by elements, by whatever. It helps us to really understand the cost. Now, you may have a cost that is direct cost, that's by nature classification. And when you come to classification by element, it may find itself under labor. And if you come to the side of classification by behavior, it finds itself under variable cost. You see, so it helps you to really understand the cost structure of the company. Now, then you have to calculate what we call the historical rate. Look, for volume-driven cost items, the historical rate is just a matter of the cost per the volume per unit of item. For example, if I talked about material cost, it's a matter of the cost per unit of the material I'm going to use in the production or whatsoever. Then based on the volume I've planned to produce, maybe if it is a college, we are talking about the forecast student numbers or student population. So based on the new admissions we are going to have, and don't forget, if you're having new admissions into the school, there are some that may also be leaving the school, and that is what we call the attrition, student attrition. Now, you are admitting new people, some people are dropping off, we call it student attrition, and then we have people graduating. So it's kind of like a waterfall. You know, it flows in like that, new admissions, some people, you suffer some attrition along the way, and some get graduated. So you need to be able to project what will be the revenue or what will be the volume of activity or student population in the subsequent years. So those costs that have relationship with student population, that as student population increase, the increase, student population decrease, the decrease, those cost elements can actually be forecasted based on your forecast student population and also based on the cost rate or that cost item per student. What do you think that cost is going to be going forward? All right. So I'm actually not getting much or deeper into this. And so that is the historical costing. Now, when we come to activity-based costing, and of course, if you done management accounting, I think, I don't know if someone has written something on this. Let me just, I want to unshare and then reshare my screen. Yeah. Okay. Give me a thumbs up if you can see my screen now. Aliu said, I can't hear you again. I'm not sure others are experiencing the same thing. Great. I'm audible. Means I'm audible. Okay, good. Thank you. All right. Now, so activity-based cost, and these things, I don't feel like dealing so much or getting so much into these details. I've been in management accounting for quite some time. I've used some of these things before, but then because there are a lot to cover, and I want to leave out this. Here you are forecasting costs based on the level of activity. So what it means is not just level of activity from the level of the company, but then for each of the cost items, can you identify the actual or the key activities that drive these cost items? So if you talk about a cost like staff cost for the faculty, you are looking at how many staff do we have or how many staff hours. So if you are paying your labor per hour, you are dealing with how many hours will be required in the next financial window. And that will drive the labor cost. The more hours you do, the higher the cost. Now, there are some costs that may not relate with volume, the volume of production, but then they may be driven by a certain or another activity altogether. Think about this. If we have 3 classrooms, now 3 lecture halls, we have 3 lecture halls because we run, let's say, 3 faculties. Now, so if you look at rent payment, suppose we've rented a place. The rent payment is more of a fixed cost. Because whether we use the classrooms or not, we must pay, right? We are in that contract. But suppose we want to introduce a new program into the school, and that requires another lecture hall. Sorry. Just a moment. Okay, welcome back. So that requires another lecture hall. In that case, we need to now increase our rent because we are going to rent another lecture hall, and that will make the lecture halls 4. The additional rent we are incurring will make the rent look more of a variable rent. You see, so now the rent cost is not influenced by student population per se, but then is driven by maybe the number of programs we run. That the more programs we run, the higher the rent. You see what is now driving rent, not student population. So in activity-based costing, for each of the cost items, we're looking for the actual activities that drive these cost items. Good. And then once we calculate that, we consolidate it together. Any question on cost of sales before I move into operating expenses analysis and modeling? Any question on cost of sales? Let me get into the chat. So the slides available after the session. I'm asking because I didn't receive last week. Oh, good. Any question? Should I continue? Give me a thumbs up if you want me to continue. So we get into operating expenses, approach to forecasting operating expenses. Thumbs up or a message, or should I continue? I want to know you guys are listening to me. Okay, good. Let me get into it. Now, just like the other items, now we're done with revenue forecasting. We're done with cost of sales forecasting. So now with the revenue and cost of sales, we can come up with our gross profits. We're almost done preparing the P&L account. We can come up with a gross profit. Now, the next item will be to calculate or forecast our operating expenses. Because once we're done forecasting operating expenses, with a gross profit we've just calculated, we're able to come up with the operating profits. Then we are almost arriving home. Now, so When we discuss the operating expenses, for financial reporting purpose, most companies actually group the operating expenses into lines items. You see, so we have the administrative expenses and we have distribution costs. So, and in some cases too, especially in North America, you see administrative expenses and the distribution costs, they bulk them together and they call them the selling and general expenses, administrative expenses. So, or selling general and administrative expenses, so you call the SG&A. Now, so administrative expenses actually represent the costs associated with managing and running the overall administrative functions of the company. Finance, marketing, HR, MD's office, and all that. Now, so they may include the salaries of administrative staff. And don't forget the salary of those in production got added to cost of sales. Now, so the salary also of the administrative staff, office rent, utilities, office supplies, legal fees, accounting expenses, and other overheads related to general management and administration. That's the administrative expenses. Now, when you take most companies' financial statement, you see a line for administrative expenses. And then when you get into the notes, you see the breakdown of administrative expenses for most companies. Now, when we get to distribution costs, now, so these costs actually encompass the expenses incurred in promoting, selling, and delivering a company's product or service to customers. So these are more of marketing costs. Now, so the costs are directly tied to revenue generating activities of the business. Now, so what it means is those costs incurred in generating revenue, which are not part of the cost of sales. For example, delivering product to customers, doing promotion, advertisement, they are part of the distribution cost. Now, so they may include those items I just mentioned now, warehousing, shipping, delivery, and all that. Okay. So when we add the administrative expenses to the distribution cost, we arrive at the operating expenses. Okay. Now, so to start with, we need to analyze the historical records. If we have one, we need to analyze the historical records. Now, this is for Trendmart retail stores. So Trendmart retail store is a well-established chain of retail outlets specializing in fashion and lifestyle products. As part of their financial planning process, Trendmart aims to conduct a historical analysis of its operating expenses over the last 5 years to identify trends and factors that impact expense growth. Now, what I'm doing here, I'm looking at the analysis at the level of the financial statement. And that is what most of you will have access to. If you work outside a company, you may not have access to the details, especially but you may have access to the details sometimes, especially if these things are disclosed on the financial statement, like the notes to the financial statement. But then you can still perform the analysis at the level of the financial statement, where you look at the line item for administrative expenses and that of distribution costs. Now, Trendmart aims to conduct a historical analysis of its operating expenses over the last 5 years to identify trends and factors that impact expense growth. Now, so if you look at the history here, the figures are expressed in millions. And so key historical events here in 2020, so you have some things we talked about. In 2020, Trendmart underwent major store renovations and incurring a one-time expense of 3.5. Now, this is one thing I wanted to do. I mentioned this last week. When you're doing the historical analysis, there may be a need for you to make adjustment to the history, especially for those one-off items. One-off items or non-recurring items, you don't expect this to happen in the future. So you can actually analyze the historicals, make adjustment for those things before you start calculating your YOY or KGA. Another way to handle is this. You can calculate your initial YYs and KGA and all that. Then you put it aside. Then you make adjustment to the historicals to adjust for those one-off expense in the past and all that, which found their way into these items. Once you are done with those adjustments, you recalculate the YY and the KGA again. Then based on that, you can make decisions on how you think the future should be. Now, so when you make adjustments to the historical expense trends, then we get what we call the normalized expenses, the normalized historical expenses. Now, when we do the adjustments as per the history, what happened in the past, we use those information to make adjustments on the historical items on the financial statement, we call it normalization adjustment. But if we expect changes in the future, if we start incorporating future changes in the business into the historical rates or historical analysis so that we can get a better trend for the future, we call that adjustment pro forma adjustment. So there is a normalization adjustment and there is a pro forma adjustment. The two are very important, especially if you consider significant changes in the operations of the business, or maybe a revision to the business model, or maybe you have to lay off some people in the future. All that must be captured in the financial projections. Okay, so today too, I expect some level of engagement, right? I expect some level of engagement, and I want to say that you can get these because you have this, you can put it in Excel and then perform the analysis in Excel for me. Perform the analysis in Excel for me. And then you can paste in a comment box and let's see how it goes. Now, some new information here. But first, let's analyze the history before we start thinking about the historical events that we are going to use to adjust this. Let's analyze the history. Let me, while I still showing my screen, let me try opening my Excel. One moment, I want to stop sharing my screen for a moment, but then you have access to this. So let me just stop sharing my screen for a moment and just open my Excel. Okay, Isaac, your hand is up. Okay, I think that was when you were giving a thumbs up. Let me get my Excel opened. Okay, get my Excel open. Operating expenses. Operating expense modeling. Let me take off my grid lines and just a moment. I want you to also be doing the analysis alongside, right? Let me just paste this in the Excel. At least for now. Just one moment as you also do the analysis. Okay. Okay, good. Sharing back my screen. Let me see those that have done something so far. Okay, so I think I should just get straight into this in Excel so we see how it's looking like. So if you can see my Excel screen, put something in the comment section. Daniel is asking what is the best approach for cost modeling. Well, there's no best approach. It's a matter of available information and whether you can make a sense of what you are doing. If you can justify whether the gross profit margin or whatsoever margin should be fine. Okay. So I hope you can all see my screen. Trying to increase my screen a bit. So now, so with what we have here, we can calculate some key performance indicators. So let me just write it, KPIs. So we can do some KPIs calculation here. We can do admin expenses, expenses. So here I want more of YOY. Admin expenses YOY, and we can also do distribution costs YOY. And let's calculate that. So of course, we have it from 2019, so we can start calculating from 2020. To handle my errors in my work, usually I do this. So 2020 divided by 2021 minus 1. And if error, just write or just do not applicable. Okay. So I've done the first one here. And also, I can just drag down for the second one. Good. Oops. They all seem to be growing at the same rate. How did I make it look like this? They all seem to be growing at the same rate, eh? 3.11%. Constant growth. I don't know how I got into this. Now let's look at KIGA growth. Let's look at the KIGA. So let's put KIGA here. So KIGA growth. So to do KIGA, it's a matter of doing RRI, and I'm looking at growth over four-step growth. So 4, then the starting value is this, and the ending value is this. Now, so we have 5.5 or 5.05 KIGA, and here to 5.05 KIGA. Of course, that's very obvious because we are talking about something that is growing YOY at constant rate. Of course, it should have similar or the same KIGA. I see work being done here. I'm seeing your SL, Olayinka. Let me show Olayinka's work. Why am I? Wait a moment. Trend analysis. Are we working with different figures? Because what you're showing here, it appears we are working with different figures, right? Administrative expense 3%, 10%, 2%, 5%. Oh, how did you arrive at them? Well, I'm making a mistake. Someone correct me if I'm making a mistake. Can we all spot the problems in Olayinka's work? Can we spot the problems here? Who can spot the problem here?
Please, can you hear me?
Yeah, I can hear you.
Probably he didn't start from year 1.
Okay. No, if you're talking about he didn't start from year 1, like how? Just having a bit of a problem with
Your
that.
workbook,
Okay. Let me hear you.
Your workbook formulas are not calculating. Check your formula calculation option.
Okay, let me do that. I think that I certainly think there's a problem with formulas. Maybe I have to update something there quickly. Just a moment, team. Let me just take this off. I don't know why I have too many things open here. Okay. Oh, okay. It just calculated now. Thank you very much. I think my workbook of late is just quite slow with some of these things. So let me check my formulas. So one area I check formulas to check whether, I put it on manual. I was doing some work and I don't want the SL to slow down. So I put the calculations in manual. That's the reason why I didn't calculate. See the challenge? Those are some problems that you may face, especially if you're working on large files and you don't want and things keep freezing. You can change the formula to manual and later change it back to automatic. I didn't change it back from manual to automatic. Thank you very much for that observation. Thank you. Now, so let me show you share my screen now so you can see what is happening here. Okay, so I hope you can see my workings now. Now, the things I've calculated, I currently hold my work. Can you see my screen, my Excel screen? I think you should cross-check your decimals, and I think you should cross-check your data. So, okay, so wow, look at something that Bavia did. Bavia has done this, so I hope you can all see. Have the administrative expense, YY, 5.11, of course, 3.11, of course, what we just did, and it had a CAGR of 5.05, and the distribution cost, of course, over this period, a CAGR of 4.99, but overall, operating expenses growing at a CAGR of 5.03. Now, you can check the level of variability in the growth in administrative expense compared to the level of variability in the distribution cost. So the question is, if I keep growing things at CAGR, meanwhile in the past, especially in 2021, I saw 10.34% growth. Well, that may not be that great because I may end up under charging costs. But then in 2022, we have 1.95. In 2020, it was just 3.11, right? Which are both below. In fact, 2020 growth, 2022 growth, and 2023 growth are all below that of the CAGR. If you get to the distribution side too, you see 2021 standing out. There may be something associated with this 2021, definitely. And when you look at the overall cost or operating cost of the company too, you see similar trends. The 2021 is almost like an outlier. What is it about 2021? You see, with historical analysis, you start questioning the history. You start questioning that there may be something, you start flagging out some few things, and then you may concentrate your effort on that. Number two, why this 1.95 growth in 2022? That looks a bit low. Is this something we can look out for in 2022? Okay, so this is just the historical side of things. So let me share my screen now on my Excel. Okay, so a similar thing I've done here, right? Good. Now, we have new information or we have additional information. Perhaps after we looked at the history, things are not that clear, so we decided to visit the company or talk to, or maybe if you work in a company, you decide to investigate this. So in 2020, Trendmark underwent major store renovation, incurring a one-time expense of 3.5 million for store upgrades and modernization, which were all included in administrative expenses. Now, I want you to type, we got to get fast here. This one-time expense, is it an adjustable or an adjusting expense or unadjusting expense, or is it an expense we should take out of the history? Do you think it's an expense we should adjust the history for, or we shouldn't adjust the history for this expense? Because at the end of the day, we want to determine a normalized average growth rate. We are looking at a normalized growth rate. Meaning we want to look at the history, and those items that are not recurring, we adjust it. Is it an adjusting expense item? Okay, Daniel said adjust. Olayinka said we should adjust. COVID lockdowns, adjusting expense. Bavia, okay. Adjusting expense. Recovery from COVID. So please check your formula. Okay. Now, please, it should be adjusted since this is not expected in the future. Okay, great. That's from Idrisu. We adjust. All right. Okay. Good. So in 2021, so we're going to adjust this. So this will be adjusted in 2020. So guys, quickly adjust that. Let's see. So in 2020, administrative expense, we have 23.2. Now, we need to back out this 3.5. So that is going to give us about 19.7 or so. Yeah. Now, in 2021, Trendmart expanded its operations by opening 3 new stores. Now, incurring 1.8 million for store setup and initial marketing, which were all included in distribution costs. Wow. So, distribution costs. Is this a one-time expense? If it is, should we adjust or we shouldn't adjust? Let me see that. Adjust or don't adjust? Adjustable expense. Okay, so adjustable expense. We have to check if it happens every 5 years or something. Oh, that's a great one. That's a great one. That's a great one. We have to check, because if we are now forecasting, if we want to forecast the operating expense now, we need to consider the strategic plan. Of course, Daniel, that's the reason why you may have to look at the strategic plan to see if they plan new store openings within the next 5 years or over the forecast horizon. Adjustable expense. George said the CAGR calculation, why do we use 4 years instead of the 5 years data presented? Yeah, 4 years data point by 5-year data point by 4-year growth window. 2020 grows to 2021, 21 grows to 2022 in that order, right? And Olayinka, looking at if we look at their strategic plans going forward, we'll know if they have any plan like that. So we adjust. So guys, adjust that in your worksheet and let's see. And then in 2022, Trendmart conducted a clearance sales to liquidate excess inventory, incurring a markdown expense of 1.2 million, which was included in distribution costs. In 2022, should we adjust or we shouldn't adjust? Let's look at that again. So the clearance sales, should we adjust? Checking the comments to see what you guys have to say. Whether we should adjust. Adjust. Daniel said adjust. Adjust. Yes, I agree. We have to adjust. It's a one-time expense. Now, in 2022, due to competitive hiring pressures, wages increased by 8% for sales representatives. In 2022, wages increased by 8% for sales representatives. Well, they didn't give us the actual wage, but I suppose we've been giving the total wages in the previous year. Do you think this is an event we have to adjust? I mean, the event relating to the wage inflation. Is this something we should adjust? No, don't adjust. Good. Because these things are likely to happen again. It will continue. Exactly. No, so we are not going to adjust. You will not adjust. It will continue, or it may even be worse in the future. Good, I agree. Last one, in 2023, Trendmart organized a high-profile fashion show event to promote its brand, incurring an event expense of 0.5 million. This event usually happens every 5 years. Adjust or don't adjust, or you can explain. Which is which? Which is which? Benedicta made a point. I think they'll respond to you, Benedicta. Which is which? Are we adjusting? Are we adjusting for the high-profile fashion show? Adjust or we shouldn't adjust? Don't adjust. Okay. Why? Seth, can you provide basis for that? Why you think we shouldn't adjust? Please, can you provide? Okay, reoccurring. That's true. Now, Toyosi said, please, can you explain why we are not adjusting for wage increment? Yes, because something that is likely to happen. Next year, there may be high demand for similar shop attendants. You know, the attrition rate or the turnover rate of shop attendants is quite high, right? Or sales representative is quite high. So some people have to go back to school, some have found another shop and all that. So it is a normal thing. It's a normal thing. There's no need for adjustment because the 5 years, don't adjust. They say it happens every 5 years. Okay. Well, it all depends. Please, can you explain adjusting and non-adjusting events again for better clarity? So what I mean is that we are done Or we just did some YY calculation or CAGR analysis of the historical operating expense. Now, we want to see what we consider as a sustainable operating expenses going forward, the actual level. So in the past, there may be some events that cause operating expense to rise, which we think those are one-off or one-time event. They may not occur again. So if we say operating expenses have been growing at a CAGR of 5%, maybe it's growing at a CAGR of 5% because of that one-time item. If we adjust the data, what will be the impact on the growth? Will the growth dynamics in the past actually change? If they change, maybe that is reflective of what is likely to happen in the future. All right. So based on this, can we rework out the figures? Based on this, the adjustment we are making, can we rework out the figures? Can we rework out the figures? So 2020, we are adjusting by 3.5. 2021, we are adjusting by 1.8. So you need to see whether it's admin expenses we are adjusting or distribution costs, right? 2022, we are adjusting by 1.2. 2022, we are adjusting by 8%. Sorry, we are not adjusting for these operating expenses. Sorry, the sales representative costs because of this is a normal feature of the business, right? That's the reason why you need to understand the business in question. 2023, we are adjusting. Oh, well, some people say we should adjust, some people say we shouldn't adjust. It all depends. Because if this happens every 5 years, the question is, should we make that adjustment when we are doing the projections? Then first we make adjustments, we calculate the growth rates based on normalized operating expenses, we calculate a growth rate. Then when we are doing projections for the 5th year, we may make that adjustment, or the next 5th year window, we make that adjustment. Now, so calculate that for me. Let's see. Let's do the adjustment for me. 2 minutes more to go on that. Then from there, we can get into approach to forecasting operating expenses. Olayinka is done. Let me share my screen so you see what Olayinka has done. Okay. I think I'm showing the correct thing, right? Let me close some of this so that I can. Just a moment, guys. Q&A. So I can show what Olayinka just did in the charts. Okay. Okay, so let's see. Let me show this. I don't know why. Just a moment, guys. I think my screen is more of like, okay, good. All right, so this is what Olayinka did, right? So he made adjustments, and it would have been great, like if the picture you've taken is showing what we did before the adjustment and post adjustment. So we see how the trend analysis like. So we have a decline here, then an increase, then a slight increase. So if you can put this side by side, so we can compare, that would be great. Who else has finished? I want to see work done by others as well. I want more people to participate in this. I just see few people participating. Okay. Bavia, just as always. Bavia, okay. So Bavia's own here. Good. Now, so I love the level of diligence being put into this by some of you who are regularly doing this in Excel. I really appreciate, and I want more people to be doing this. I love to share the screen and share these things for you to see, because so that those who are watching online on YouTube can follow. So look at this. Adjusted administrative expenses. So before This was what we're having. And then we made some deductions, okay, from administrative expenses. And so these are adjusted administrative expense, and this is a YY growth in administrative expense. I want to, so this YY growth is actually the YY growth post adjustment. So it gave us a CAGR of 5.05. Now, he did the same thing for distribution costs as well, adjusted 2021, 2022. Then he calculated the YY after post adjustment. So we've taken off those items we considered one-off, and then we get a CAGR of 4.99. Then we did for the total cost at the end of the day based on adjustment, and then we get 5.03. Good. So the point is this: going forward, we may prefer to base the forecast on maybe the CAGR based on the adjusted operating expenses. So we can base on the forecast on the CAGR. So sorry, there is a mistake in YOY calculation. Okay, so he's issuing a disclaimer. But then generally the presentation, I love it. And I think the explanation or the idea behind this have been well communicated. Good, let's continue. It's already 11 o'clock. Not done enough. Okay, let's continue with this. Okay, so I've just done that now. I supposed to have brought this, but then I talked a lot about this approach to historical analysis. I don't know why I messed up my slides. This is supposed to have come before the question, but then it's fine. So I talked about a lot of these things already, so there's no need for me to go into details to analyze them. But one thing you can also do with the analysis you've done is that you can look at the inflation rate in a country. If you look at the inflation rate in a country, you can match it against the growth in the administrative expenses to see whether the administrative expenses or the distribution costs are growing at a rate faster than inflation or below the inflation, right? So it gives us some idea into how the company's operation are exposed to inflation. I talked about adjusting for special events that we just talked about, seasonalities, and based on that, we recalculate the growth. Basically, I talked about all of these things. Now, approach to forecasting operating expenses. How do we do? Number one, going forward, you consider the business plan. So you need to understand planned expansions and new product launches, changes in the business operation that you believe could have impact on operating expenses. You need to check out that. And then when you handle the business plan, that feature into the revenue projections for the period. And that may also drive what you consider to be the growth in expense rate. Then you may calculate some expense ratios. Of course, now you can calculate some historical ratios of operating expenses to sales for each expense line item. For example, I can, like the groupings I just gave you, administrative expense, I can express it as a percentage of revenue and forecast, but then that is not a proper way of doing this. The reason is that administrative expenses may be more driven towards fixed costs than variable. So when you grow it based on revenue, you may not really get the linkage right. Now, so once you calculate all these growth, expense growth rates and all that historically, and you make all your business or adjustment for business changes in control and seasonality and all that, then you can then forecast the expenses for a period that you're doing the forecasting for. So there's a question here I want us to look at. Now, so this Industrial Plus Enterprise. And so Industrial Plus Enterprise is a renowned company that operates an expansive industrial park, providing premium facilities or faculties to diverse, I think I wanted to write facility, I'm sorry, to diverse industries. The company aims to forecast its operating expense for the next 5 years to support financial decision-making and maintain financial stability. Extract from the historical annual report as follows. So this is what we have from the annual report. Now, over the same period, the industry as a whole experienced a CAGR of 5.5% for administrative expenses and 6.2% for distribution costs. Meanwhile, IPE's revenue CAGR is 5.8%. The industry is expected to witness heightened competition as new players enter the market with innovative facilities. and cost-effective solutions. The macroeconomics anticipated to experience moderate growth, driving demand for industrial spaces and boosting the revenue potential for IPE. Now, meanwhile, inflation over the forecast period is expected to be 100 basis points above the last 5-year average. Above the last 5-year average. And you, I think I provided you with the last 5-year inflation, right? I believe I did. Okay. Well, now let's continue. Whether I provided you or not, that will not affect your analysis. Now, one thing I want to also say, when I give information here, some of the information may be useful, some may not be useful. I'm just giving you a world of information. Then you now determine which one works for you, right? The labor market is projected to tighten, potentially leading to wage inflation. Rapid technological advancement may offer opportunities for cost optimization and improve operational efficiency. Now, based on this information, determine the appropriate growth rate to use for forecasting each category of operating expenses over the next 5 years. I want to hear from you. How should we forecast this over the next 5 years? The appropriate growth rate for administrative and distribution costs. So I'm giving 5 minutes for you to handle this. Just 5 minutes. Or let's make it 7 minutes. It's now 11:05. I don't know if 5 minutes will be fine, but then we can do 10 minutes so that I can do a good job. It's 11:05. Let's get back 11:15 GMT. Great. Let's do that quickly. So I think 2 minutes more. Let's see. Okay, so I start seeing some responses here. I will use 6.5% growth for admin expenses, industry average +1, and group distribution expenses at the rate of forecasted revenue growth. Okay, so a rate of revenue growth, and I think that's a reasonable assumption to make, Daniel. Olayinka said, I would prefer to use 5.5% growth for admin as the CAGR is 5.53, meaning the calculations are done, realize the CAGR is 5.53. And that's pretty close to the industry CAGR as well. And the distribution expense, I would want to conduct like common size analysis just to see how the distribution cost has been moving with revenue and find a strong base for my assumption. Wow. That's true. That's a positive one. That's a positive response. Do we have something for anyone who's comparing to this? Okay. Okay, let's wait for a minute, then we continue. All right, so I think Godlove is saying, Julius, won't comparing to inflation present a challenge, especially if the national inflation basket is significantly different from the company's cost structure? That's true. That's true. Yeah, that's a fair point. That's true. That's true. So it isn't that I'll say you should use inflation as benchmark, but then just to have some idea, because if you are looking into the details of the makeup of this cost, you may want to consider inflation. You know why? Because some of these costs may grow at a level above inflation, like staff. Staff costs like this, you may want to mimic the growth in salaries as per that of the inflation in the country, right? Good. So that's a fair point from you, Goslav. Okay, great. And the message from Victor said weighted average. Victor said weighted average SG&A. So it's taking 60% of 5 and 40% of 5.7 and then growing it. And he's thinking that should be going forward. I use the industry kicker adjusting for inflation. Okay, so adjusted for inflation. I think that's also a fair one, Victor, to use. Idris to say admin expenses increasing at a decreasing rate towards the industry kicker and is expected to reduce to the industry kicker. I will start with the CAGR of 5.53 in the first year and reduce the I think CAGR of 5 thereafter. Okay, right. I agree. Thank you, guys. Thank you for the engagement. Now let's get into that for commercial banks. Let's look at last time we looked at the revenue projection for a commercial bank. Let's get into that of the cost side. So now, commercial bank cost is made up of, we can group it generally into 4. The interest expense, which is a cost associated with the bank's deposit and borrowings. Then we have fees and commission expenses, which is a cost associated with the fee and commission income. Then operating expenses, which comprise of the other matters, general and administrative expenses such as salaries, utilities, IT services, and all that. Then the other thing is depreciation and amortization impairment. Of course, these are actually notional expenses, right? Now, so of course, if you want to do cost control, you are looking at the other 3 mainly. Now, so what are the key drivers of a bank's cost component? So here, interest expense. Interest expense is mainly driven by deposit mobilization, which also impact the level and growth in deposits. And so company that is, or the bank that is aggressively mobilizing deposits is likely to also do so at a higher cost, right? Because of the competition on the market, if a bank is mobilizing more deposit, it's likely to be doing so at a higher cost. The bank's deposit rates on the various deposit portfolios set as fees, savings, demand and call and all that accounts also have some implication on the interest expenses. Then the stock of borrowings and borrowing rates. So banks also borrow, and then the borrowing be short-term or long-term. That may all affect interest rate, especially the interest expense, especially the long-term borrowings. Fees and commission income. So these driven by the categories of the fee-based services that a company provide and the cost of service provision itself. Then operating expenses here, generally inflation. In fact, it isn't like inflation doesn't affect interest expense. Of course, the interest rates on the deposit may to some extent be influenced by inflation, but not entirely, because we see the cost of deposit mostly below the inflation rate. And so it just tells you that if you keep your money on deposit without investing it, you're actually going to be getting your money losing value over time. So operating expense, staff contracts, expansion, restructuring, just similar to whatsoever we see outside the banking world. It applies to operating expenses and the depreciation and amortization. Good. Now, so this will be before we looked at, okay, now let's look at some historical analysis of cost here. So we have some questions here presented here, and would be great if we can have these questions solved. We've been dealing with this bank called Triple Trust Bank, PLC. Last week, we handled this when we discussed the revenue forecast. And so we're presented with the income statement and also with the bank's balance sheet. On the balance sheet, you have the customer deposits there. And then borrowings, we have that. Then income statement, you have interest expense for the borrowing, interest expense for the deposit. Then we have the fee expenses and the operating expenses. We want to concentrate on these ones and take off that of the notional costs like depreciation and all that. I have a question here. Is a question, let's see, please, how does inflation be an operating expense. No, we are saying that inflation influences the growth in the operating expense. That's what we're saying. It could drive operating expenses. That's what we mean. We didn't get a slide for last week. Well, I believe the slides were shared last week, but you can follow up again. Now, so we can do some historical analysis, right? I believe we can do some historical analysis here. Based on what we have here, if we express the interest expense, so I'm not going to do much work in Excel here. If we express the interest expense as a percentage of the deposit, it can give us what we call the cost of borrowing or the cost of deposit. So for example, the interest expense for deposit divided by the customer deposit will give us a cost of deposit, right? Then if we express interest expense over the borrowing rate, it can give us the cost of borrowing. Now, so we can actually analyze the cost of borrowing over time, just like the way we do the YY analysis and all that, those ratio analysis over time to see stability in the ratios and how we can do. The same thing can be done here. We can calculate the CAGR in fee expenses to see whether the figure is consistent or not in terms of whether the growth rate is stable or not. We can look at operating expenses. We can calculate CAGR and YY for operating expenses as well. Right, that's approach to analyzing this. So you can try your hands on it. Now, when we're modeling the bank's costs, there are some factors we need to consider. So macro industry considerations, and so we can evaluate historical trends in inflation, economic growth, and their impact on industry deposit rate and deposit growth. The question here, please, how does inflation be an, oh, I think almost, okay, I think that was a response to the question asked by Daniel. All right, thank you very much for you. Now, so we can look at bank-specific factors as well. We can look at historical growth in the bank's deposits and deposit rates in the context of the industry and the macroeconomic environment performance. So based on history, we can determine what should be the deposit growth going forward. Because as we expect GDP to grow, or the real GDP or nominal GDP to grow, we expect deposit to also grow. There's some good relationship between GDP and deposit mobilization. Of course, it means businesses are going to perform. If businesses are going to perform, it means that there will be some kind of like increase in deposit mobilization. Now, increase in deposit mobilization may come at a cost. And also, number two, even if the economy is not likely to perform well, deposit mobilization is going to be very difficult, then we'll be thinking about going to borrow from alternative markets to finance our assets, like, to grant loans and all that, or to put in government securities, whichever way you want to do it, depending on the bank's asset liability management strategy. Now, if it's going to be difficult financing assets using deposit, then you may want to borrow, but that comes at a higher cost as well. So there's some form of analysis you got to do when it comes to these items, right? Right. Now, so I provided some information here on how then do we forecast. Now, so we've been given the sector average cost of funds here, the average cost of funds for the banking sector. And so if I say cost of funds, it means it includes both deposits and borrowings, the average cost of raising this funding. That we've been given the operating expense growth rate for the industry, 20%, 18%, 25%, 30%. Now look at the inflation to rates that we've been given. So if you look at the inflation rate, it's almost similar to the operating expense in terms of trend to some extent. Fee and commission growth rates who have been given for the industry. So these are industry figures. These are macroeconomic figures, and these are also industry ones. So what do we do if we want to forecast? On the previous two slides, we were given the historicals. Based on the historical analysis, we can determine what we think the growth rate should be. But then in the context of what we see in the sector or on the sector, the sector values that will be given us here, and also what we expect in the economy. Of course, for example, the sector customer deposit grew at a CAGR of 28%. So if you look at a CAGR of 28% growth in the sector, and then you look at the CAGR growth in your own performance. Based on that, you can have some idea of what you think the deposit is going to be going forward. If you're able to forecast deposit and perhaps borrowing, but then much emphasis on deposit, you'll be able to now calculate your interest expense by multiplying the deposit by the cost of funds you have arrived at after evaluating your history and also for the market. Same thing applies to the other cost items as well. As I mentioned, I'm not going to do this in Excel. Just explain, because we've been doing similar things over and over again. We have quite a lot to do today. Debt modeling is coming after break. So before we, after we back, or when we back from break, then we get into debt modeling. So there's quite some interesting things to do today, right? Now, any question? I have some few slides on working capital modeling. I think we can take a 10 minutes break. Should it be a 10 minutes break? Yes. Let's take a 10 minutes break. And so it's now 11:27. Let's be back 11:37. So let's have a 10 minutes break. And when we are back, we look at how we model working capital. So now we've done revenue, we've done cost of sales, so we're able to determine gross profit. Then we went ahead to do operating expenses. So now we're able to get operating profit. The rest is a matter of taxes, then interest expense on the debt the company has. So we'll be doing debt modeling, and that will solve that problem. Then tax is just a matter of multiplying something through, right? By the tax rate. Can we have a certificate after completion? I'm not sure about this. Okay. Now, so working capital is landing us right into the balance sheet. We are getting into the balance sheet. With the working capital modeling, we're able to calculate receivable value. We're able to forecast receivables. We're able to forecast payables. We're also able to forecast inventories. And then maybe other receivables and other payables. We're able to forecast all that on our working capital. So we have quite enough things to do. So let's get back at 11:38 exactly. So 10 minutes break. Thank you. All right. So I think we can share the break, the screen for the break time period. All right. I think welcome back from the short break. So we getting straight into this was continue. All right, going straight to the working capital components of what we're coming to discuss. And interestingly, let's get into the working capital. So just one learning outcome statement here. Develop an understanding of the key considerations in modeling working capital. Key considerations in modeling working capital. Now let's get into that. Now, so everything starts with historical analysis. If you've been following all along, we start every analysis with historical analysis. Okay. Now, so this involves a detailed examination of the individual components of a company's core working capital, including the inventories, the payables, and receivables over a specific historical period. So the goal is actually to gain insight into how each component has evolved over the time and also understand the drivers behind the changes and identify patterns or trends that can inform future forecasting and decision making. That's very important. So there are 4-step process involved in this. The first one is the data collection, where we obtain the historical financial statement and gather data on inventory, payables, and receivables over the period under review. The second stage of the modeling is to calculate the efficiency ratios. And when I say efficiency ratio in this context, I'm talking about the inventory days outstanding, the receivable days outstanding, the payable days outstanding, and let's say the cash conversion cycle for each historical period. So if you collect this data over a 5-year window, meaning you have to calculate each of these metrics over a 5-year period for each of the items. Then you identify drivers of change. So sometimes you can graph the days, the receivable days, the payable days, the inventory days. You can graph it in a trend line or using a trend line. And based on that, you can observe the fluctuations and then obtain explanation for why the fluctuations in the level of this component of working capital, the receivables, the payables, and the inventory. Then also you can look at the industry benchmarks. So you can grab the company's working capital ratios along with industry benchmark to assess how the company performs relative to its peers. And so this one helps you to identify strengths and areas for improvement in the company's working capital management. Okay. Now, let's look at TrendyWare. Again, now, so we dealt with TrendyWare some minutes, I think some time ago or so, under cost and revenue or so. So Babia is asking, sorry, if you don't mind, can you explain the meaning of working capital intentionally? Oh, okay. Let's put it this way. Working capital is just the funds you require for day-to-day management of operations of the business. Now, so management, day-to-day management or day-to-day operations run into sales revenue. So it has to do with generation of sales, and you perform activities to generate sales, and those activities run into costs, right? They increase your cost of operations and all that. So when we say operating activities or the day-to-day activities of the firm, it's more of the revenue and the cost. Okay, so those are the things we do on day-to-day basis. We don't invest in assets on day-to-day basis, but we incur expenses on day-to-day basis. We also make sales on day-to-day basis. Right. So how much do we need to keep operations moving? You'll see clearly that if we generate sales and the sales is cash sales, then we are cool to go. Because in that case, we have the cash to fund day-to-day operations, paying salaries, paying rent, and all that. But if we generate sales and all the money we got from the sales are actually on credit, or sorry, the sales we've made are on credit, then we have a problem. We need money. We need some money to fund day-to-day operations while we wait for our customers to pay us. Now, on the other side too, when we look at operating expenses or cost of sales and all that, those are also expenses we incur. Some of them may be on credit. We may buy inputs on credit and all that. We need money to pay salaries and all that. Some may be on credit, some may be cash we are paying now. So there may be there may still be outstanding amounts in terms of operating expenses and cost of sales items we need to pay. Now, and also we may buy inventory on credit as well. Some may be on cash, some may be on credit. So when you look at it generally, we may have some outstanding sales we've not collected. We've sold goods on credit, we've not collected the money, which I'm calling outstanding sales. There are monies we expect to come in. And also, we need to make some payments, which are also outstanding. We need to pay our suppliers, we need to pay salaries, we need to pay all that. So we have outstanding sales, and they are promising us that they're going to pay us. We also need to pay some creditors. How do we raise funds? Or how do we manage that level over time? Do we, at some point, we may need to borrow money from the bank, maybe take an overdraft to manage the shortfall? Because maybe on average, our customers will be paying us in 30 days time, but we need to settle our supplies and all that in 10 days time. How do we manage that? So we need some capital within or some bridge financing to finance the working capital while we wait for our customers or to finance those creditors' payments while we wait for our customers to pay us. It's all part of the working capital management. And we can actually determine the capital required, the additional capital required in working capital. All right, so let's look at this historical analysis. So we have trading way here. And so from the history, we have receivable days of the company, we have sale inventory days, we have payable days. So I've done some plotting here. So if you see the inventory days, it's a plateaued between 2018 and 2019, almost constant. It's constant 60, and then it increased to 80, increased to 85, and dropped to 75. And we have receivable days, it increased from 40 to 60 days, then from 60 to 50 days. It just tells us how long it's taking people on average to pay us, right? Then it decreased again from 50 to 48, then it increased slightly from 48 to 50. We have payable days that decrease from 35 to 30, maintain that 30, increase to 35, and now 50. Right. Now, if we want to calculate our cash conversion cycle in a way, the next time period it takes us to collect all our money is just a matter of 60 minus 40 minus 35, right? What am I doing? 60 plus 40, then plus 35, because you are using the inventory and the receivables to finance the liabilities, which is payable days, right? Now, we've been given also industry average efficiency ratios, 40, 35, and 70. Now, what I want you to analyze, whenever you see these things, look at the level of, or evaluate the level of stability in these ratios. Like 60, 60, 80, 85, 75, quite volatile at some point. And a receivable is quite erratic, right? And when it comes to payable, stable to some point, and in 2020, it went off. And if you compare the payable history to the industry average, it's similar, at least between 2018 and 2021. And if you look at inventory days for this company, it appears that industry is doing better on average. Inventory is not taking too long to sell. But then this is trendy wear, right? They're into clothing, they're into fashion. You know, the clothes may not expire really like that. So it's commonplace to keep things in your shop for 80 days. But then what it means is that you have locked up your money too. You are not getting your money back, which isn't also a good thing. Now, some question. Okay, there's no question yet. All right, just some things they dropped in the chat box. Now, so in 2019, some adjustments needed here. The company extended more generous credit terms to customers to boost sales. Now, because I looked at this history and things are not that clear to me, I want to investigate. So I was told that in 2019, the company extended more generous credit terms to customers to boost sales. So let's get to 2019. What do we see? So receivable days increased significantly. Oh, because of the creditors, a lot of people were sold goods on credit. So there are more sales on credit that are still outstanding to collect. So it makes sense why this increase from 40 to 60. The question we need to ask ourselves is this a one-time event? Then 2020, trending were experienced rapid growth is leading to higher inventory levels and longer inventory holding periods. 2020, rapid growth. They bought a lot cheaply. 2020, is that really true? Yes. Inventory days moved from 60 to 80. A bit of a problem. Concern there. Would they be able to recover? Would they be able to sell? But then again, they will tell you that fashion doesn't expire, right? But then the thing is that it could get it may not be ageless. So of course, if you have those stock in your inventory, maybe new arrivals may come and the old ones may not be things you would like to sell again. The prices may drop significantly. So keeping inventory for long too isn't a proper thing in the fashion sector industry. Now in 2022, a key supply chain caused delays in payable processing. In 2022, payable processing. Okay. So this is more of a one-off item because things have been stable over time until 2022. In 2022, again, training were implemented improved inventory management system, linking each system to that of key suppliers to facilitate real-time inventory level monitoring. So now we have something better. A drop of 10 days. That makes some sense. That explains that. Now, so the question would be, you have to analyze this and identify what you would consider as a sustainable level of working capital the company should apply to forecast future working capital requirement. Now, let me see in the chart. What do you think should be the sustainable level of working capital? What should be the rate, the days going forward, the working capital days going forward? Inventory days. What inventory days do you think is you want to consider sustainable based on the information I provided going forward? I want to see that in the chart. I'm waiting. Let's take 3 minutes to do that quickly. Just a matter of just averaging some few days and see. Now, this may not be clear to you well, and now if you have never forecasted working capital before, but you see it soon, you'll be asking us, so why are we dealing with this? Yeah, you see it soon. Why are we dealing with this? I want to see that in the chart. Where are you guys? I hope you are with me. I don't want to start mentioning names. I don't want to mention names. So please, let me get your responses quickly. Then we continue with that. Any response? What do you think? What do you want to consider as a sustainable level of working capital in terms of the days? If some people are not back from the break period. Wanda says, okay, Bavia says 72 days for inventory. Can you provide some basis? So once you write, I want you to provide some basis for a response. Is the average? Okay. Any reason why you think average is fine for inventory? And then if so, what for the other days? I was also thinking to take maybe the median. Maybe, because if you look at the days, they've just explained to you why the inventory level rose in 2020. Before then, things were quite stable, right? Okay. Daniel said, I want more engagement. There are people who are not talking. Daniel's receivables average from 2020 to 2022. Yes, so just based on what Daniel said, let me say something here. It's not a time that you have to average out everything in history. Sometimes you may take average of just some period, not entirely all period. You can take average of like what Daniel is doing here. He's taking, let me go here. So Daniel is taking average from 2020 to 2022. Receivable this. Let's see why Daniel could do that. 2020 to 2022. For the receivables. Sorry. I think, okay. So 2020 to 2022 receivables. Let's look at it. 2020, okay. Prior to that, 2019, that's 60 days there. It was because of that generous credit terms that they extended. So Daniel has taken off that and they say, well, let me just average periods after then. You see, 50, 48, 50. That is cool. And it's saying inventory 2022 levels for inventory going forward. That's reasonable. Payable average from 2018 to 2021 is taking off that last one because of the delay in the inventory, the payment processing that resulted in that. And I think that's fair. But I've just said, because average wouldn't be that effective due to volatility in the days after 2019. That's true. So the use of media makes sense. And Nana Sawa said, I will go for 70 days based on the industry ratios and based on the fact that TrendingWare seeks to improve inventory management system. Okay, 70 days. All right. So I get where you're coming from, because they were once at 60. So it makes sense if they want to change drastically to 70 to be at the level of industry, and they want to make improvement. I agree. In the question and answers, anonymous participants said, what does it mean when the payable days is greater than the sum of the inventory and receivable days? What it means is that we are going to get our money back really quick, and then you'll be able to repay our. So you see, the thing is that to manage working capital, this is one thing we do. We want to extend, or we want to delay payment to suppliers, all other things being equal. And they want to speed up the rate at which we collect the money from our customers, and also the rate at which we convert our inventories to cash. So that is actually a good thing. A negative cash conversion cycle, but that is positive to us. Do I just take the absolute value as the cash conversion cycle? Oh, no, of course. The negative cash conversion cycle means that we get our money back really quick, right? We can turn out things again and resell, even sometimes resell and collect our money even before the payables are due to be settled. Okay. Do I just take the absolute value? Okay, so I think we can continue now from here. Good. Now let's get into calculating the core working capital components, what we've just been talking about. So when we talk about inventories, this is how we calculate inventory value. The way we calculate inventory value is by determining first the inventory days. If we want to forecast inventory value, we take the inventory days and divide it by 365. Now, then we multiply by cost of sales. Now, another way of looking at that is to take the cost of sales and divide it by the inventory turnover. Now, I'm going to explain this inventory turnover. It means that in a year, how many times do you turn over your inventory? Like, for example, if let's say we order inventory, or at a point in time we get an inventory, the set or ordered, like what is on the balance sheet. Let's say that is the size of inventory we order. Now, how many times can I do that in a year to arrive at the same level of cost of sales? You get a point. That's the inventory turnover. So you look at cost of sales divided by inventories. The number of inventory, the number of times inventory can get into cost of sales. The same thing applies to receivables. To get a value of receivable, or to forecast receivable, we get a receivable days, the desired receivable days, we divide by 365. Now, what is receivable days? Let me explain this issue of day critically. You know, there are 365 trading days in a year. On each of these days, the companies sell and the companies also buy. Let me deal with the selling side so that I can explain receivables, and then you generalize that to the other ones. So 365 days, the company has been selling, people have been buying. We want to assume that equal level of sales happen across each day. So sales revenue is evenly distributed across days, across the 365 days. So if I take the total sales revenue of a company and I divide it by 365, it gives me the revenue per day. The revenue per day. Now, usually when we sell, companies may not sell on cash basis. If they sell on cash basis, then there will not be any debtor. Nobody will buy on credit, so no debtors balance or no receivable. But because companies don't sell on cash basis, they'll sell to you, invoice you, and then it take you some number of days to pay. They can agree with you that pay within a 30-day period. Now, if that is the policy the company has, then it means that if the company sells, maybe for this day one, it will take 30 days to sell, to pay. Day two will take 30 days. Day three will take 30 days. So at the end of the year, December 31, okay, at the end of the year, let's say December 31, 2023, we will have 30 days of sales outstanding yet to be collected. In other words, all the sales made in December may be outstanding because it takes 30 days to collect. Therefore, the sales you made from 2nd December to 31st December are still outstanding at the end of December or at the end of the year. So the number of sales days outstanding is actually 30. That is the policy of the company. So if I know the average sales per day, I'll just multiply that by the number of sales or days of sales outstanding, and that will give me the total debtor balance or receivable balance. In other words, if I know the total receivable balance, and I also know the total sales made, and I know that there are 365 days in a year, which is what we use, we take the total sales made throughout the entire year, divided by 365, it gives me sales per day, and then I multiply by the number of days I've allowed to customers. Oh, sorry, just a moment, 1 minute. Sorry, I had to address something quickly. Now, so that's how we calculate days, right? Good. And that's the meaning of days. When we say receivable days, it means the number of days of sales outstanding. Okay, sales days outstanding, or the number of sales made per day that are yet to be collected. That's what we mean. So it makes sense to say the number of days outstanding divided by 365 days times the revenue you have generated. It makes sense. Now, suppose this receivable days is 365. If receivable days is 365, it means that all the sales you've made throughout the year, you've not collected any. So just 365 by 365 multiplied by the total revenue, that will be the total receivable, meaning all sales made are still outstanding. I hope that is clear. And that clears the doubts. Because a lot of people don't really understand this. A lot of people. A question, please define the inventory turnover again. Now, so think about it this way. Think about it this way. So if I know inventory, of course, the best measure of the numerator for this formula should have been the value of the inventory in cost of sales, or the total inventory really actually booked to cost of sales. But then because we may not have that figure, we just use the cost of sales as a proxy. So we say inventory turnover is just cost of sales divided by the inventories. Now, if we know that the value of inventory is, let's say, 100, and the value of cost of sales, for the purpose of argument, is 400, it means that 4 times of inventory that you produce is what has been sold. That's one explanation. So, in other words, the total inventory sold in the period, which reflects in the cost of sales, what is on the balance sheet is 4 times of what has been sold. So it tells us about the rate at which inventory is being sold. The higher the figure, the better. You see, the higher the figure, the higher the turnover ratio, the better, because it tells us that inventory is quickly being sold. There's a situation whereby the inventory turnover is higher. If it, inventory turnover is low. If inventory turnover is low, then we have a problem. For example, if inventory turnover is 1, it means that we've actually not, it means that the total value of inventory sold is the same as the value of inventory on the financial statement. It means we are not that efficient in selling inventory. We are not that efficient, and which is not a good thing as well. It also has implications for the inventory days calculation. or working capital management. It means that so much inventory is on the books and sold. So cash is being locked in, right? In inventory. All right, let's get into it. Now, how do we then, so if we do the historical analysis of the days, what we do going forward, if we want to forecast, is that we are going to modify the historical analysis. You modify the historical inventory days we've come up with. And then based on that modified one, we use as basis for the forecasting of the inventory, of the receivable, and the payable. I've seen some modeling of inventory, receivable, and payable by people, which is quite bad. What some people do is that they just go to the balance sheet, take the receivable, and grow it at Kega. No, that's not correct. You see, the receivables, payable, and the inventory, they have relationship with items on the P&L account. So that relationship must be maintained. You must maintain it. You can't grow the receivable at Kega. No, it doesn't make any sense. You must build in that relationship. Just like the way when we're looking at interest income on a bank's balance sheet, we looked at it vis-a-vis the loans. The same way you look at this one, because of that relationship, right? Julius, does that also affect cost holding inventory such as storage? Yes, it also affects. You see, it also affects. So if the inventory turnover is low, then you need to incur more cost in holding the inventory. You see, that's creating an additional problem, right? And then all it means is that when auditors are looking at your books, when they see that inventory holding period is longer, which is also similar to the inventory turnover being low, if that happens, auditors will start questioning the value of inventory. They will now check for impairment, whether the inventory has impaired. So then that's what they looked at, the carrying amount of the inventory against the net realizable value. And they say, hey, there's impairment here. You have to write off part of the inventory, right? Good. But that depends on the industry. It depends on the inventory in question. All right. Now, so when you calculate the historical working capital ratios, they need to do adjustments. So now the modifications you do for projection purpose could be top down, could be bottom up, or could be hybrid. So for the top down here, we are looking at the industry or the sector level. And you're looking at what's happening in the industry. What is the average working capital ratios for the industry and the sector? And just based on that one, you're able to determine the adjustment you need to do to yours, whether yours is above the industry, whether some changes need to be made. Then you also look at the industry outlook, whether there's liquidity constraint in the industry, and based on that, you want to make adjustment for your working capital requirement going forward. So maybe in industry generally, sales have been dropping. If sales have been dropping generally in the industry, then it may make sense to say that you have to adjust your projection of receivables too. Because if sales have been dropping, you need some level of liquidity. So you may not want to increase receivable. But another company may look at this as so sales have been dropping generally in the industry. We want to boost sales. So could that mean we should give favorable credit terms to customers? If that is the case, give favorable credit terms to customers, then it means your receivable is likely to grow. So that brings in the bottom up, where you now look at your own strategy, the company's own strategy, the company's understanding of customer behavior as far as historical trends are concerned, the new projects coming in, the new initiatives, and use that as basis to make adjustments to historical ratios as basis for the forecasting. And there's a question, and please define inventory turnover. I think I did that. My internet is not helping me at all. Yeah, I noticed that. Now, a hybrid, which is a combination of the two, really works well, especially when I evaluate some of these things. I want to look at what is happening in the industry. I want to look at what is happening with the company. And based on that, I'm able to determine what is the growth. You see, when I do financial modeling, and a number of people I know that do a really good job, when these things are built, initially, we build a base case model based on history. That's the initial model. It's not a completed model, based on history. We don't start by just start making adjustments to things before we even build a model. We can build a base case model, taking account of just history. Then when that is done, we then make adjustments to the assumptions to reflect the future. You see the point? Good. Now, I think this is the last, or this is a slide, the last workings on the working capital analysis. And from here, we will go on break, a lunch break. When we are back, then we'll start dealing with the debt issues. Okay. Now, so TrendingWare again, we are still with TrendingWare. So let's look at it. So the company is in talks with GCB for a 5-year term loan to finance expansion CapEx. Okay. As part of the loan application process, the finance director has contracted you to prepare financial projections for the company to demonstrate to the bank the ability to repay. You are currently working on forecasting a core component of working capital, and you have intended to use the hybrid approach. You have already been provided historical working capital information on the company, which we dealt with earlier, and also is part of the workbook you have. The Ghanaian economy is expected to experience moderate growth with an average annual real GDP growth rate of 3% over the next 5 years. A moderate growth. See that? Upon analysis of the industry report and consultation with colleagues in the industry, you forecasted the fashion industry efficiency ratio as follows. So these are the industry ratios you forecasted here. You are aware that TrendingWare aims to tighten credit policies. See the point? You are aware that they aim to tighten credit policies and improve collection processes to reduce the average receivable days over the next 2 years. Over the next 2 years. Also, the company plans to negotiate better payment terms with suppliers to extend payable days and optimize cash flow. In addition, TrendingWare intends to enhance inventory management systems to reduce inventory days and free up working capital. Now, determine the appropriate working capital ratios for forecasting inventory, receivables, and payable over the next 5 years. Now, in the next 5 minutes, I want to get your comments on this development. We're almost done. In fact, this is the last case study question on working capital. Then we can go on break. Come back for debt modeling that nobody should miss. Nobody should miss. So look at this. In 5 minutes, I want to have comments on this. I want to have comments in the chat. Look at the historical performance, which was the previous question we saw, and then compare to this and ask yourself, what do you think should be the rate or the level at which working capital should be forecasted and your justification for that? Let's take a 5 minutes look at this, and let's get back at 12:16 GMT. 12:16 GMT. Let's get back on this. Okay. All right. So I think I have some. Let me see. From Daniel, receivable days dropped by 5 days to reduce it from 50 in 2023. 50 in 2023 to convert with the industry at 40 in 2023 and keep at industry level thereafter. Payable days assumed from 2021, 35 days. It will increase to 40 and remain and projected industry levels. Inventory level, use projected industry level. Yes, well, can you provide reasons behind what you've just typed there? Assuming somebody wants to know why do you think that which you mentioned should be the way forward, right? Bavia, let's look at yours. Based on the given information, inventory days should decrease. Receivable days should decrease too, as the company tightens credit policy and improve collection process for the next 2 years. And depending on how effective those policies are, we can go about forecasting the rest of the trade receivable days. Lastly, payable days should increase if the supplier agrees with negotiation. If this happens, ceteris paribus, the cash conversion cycle should decrease. Yeah, agree. Any other points? Those are great points, right? Great point. Let's move on. Now, sample working capital schedule. This is a sample working capital schedule I want you to see. So I put this together quickly. I want to run you through this, right? So you see my assumptions there. So trade payable days out of 365. So we have 30 days for 2024. So as per my workings here, 2024 is actually a historical period. So 30, 30, 30, all of them 30, 30, 30. I just want to show you something. So just look at it, 30, 30, 30 throughout. Now, so how do we forecast receivables? And I want you to see this. To forecast these receivables for 2025, 2026, 2027, 2028, we know receivables have relationship with revenue. That's how we're able to come up with the days. So we put a revenue on top here, put revenue on top, revenue as recorded. The revenue we projected to get in the respective years. Now, for example, in 2025, we want a revenue of 8.5 million. We want to maintain trade receivable days of 30. So how do we get a corresponding receivable target? Or how do we do that? It is simply the 30 days divided by 365 days multiplied by revenue. Let me take it again. It's a 30 days divided by 365 days multiplied by revenue. That gives us the receivable. The same thing I did throughout. When I come to payables, the relationship is with cost of sales. So the same thing. You take the payable days, 30 days, divided by 365 and multiply by the cost of sales. That gives me the payable values here. So I projected that. For operating expenses, for other payable, usually for salary outstanding, creditors, VAT, and all those kind of things, usually I just pack them together, and then the relationship is with operating expenses. So the same 30 days for other payables divided by 365 days and multiplied by operating expenses. And that gives us other payables. Inventories, I could have done the same, but then what I was preparing this sheet for, the company in question wasn't having, the inventory wasn't corresponding to cost of sales for some reason. So the same thing could be applied. From here, I'm able to get my net working capital. The net working capital is receivables plus inventory, then minus payables, minus other payables. So it's more of the current asset items, which is receivable and inventory here. You add them up and subtract the current liability items, which is the payable and other payable. That gives us the net working capital. So the net working capital in 2025 is 554. In 2026 is, let me add this again. This is actually for a new project. So we were not having, excuse me to say, correct an earlier statement I made. We're not having any history, right? So we've calculated a net working capital. This is very crucial. This place is very crucial. We calculated a net working capital for 2016 to be 1.16, 2026 to be 1.16, 2027 to be 1.49. With this net working capital calculated, we then go ahead to calculate the changes in working capital. Now, what does these changes in working capital represent? They represent the additional investment required in working capital. Once the change is negative, it means that's additional money we need to put into the business as working capital. That additional money required can be gotten from the sales revenues you are making on cash basis, the cash sales you are making, or you may require some of like an overdraft financing. So this is how we determine the working capital requirement. The changes is the working capital required for each year. Now, for example, in 2025, the net working capital, or which is the working capital level in the business, was 554,000. In 2026, that is expected to increase to 1.16 million. So since you need a higher working capital, you need to invest an additional 605,000 into the business. You may need to finance this from operations, or you may require overdraft financing or some kind of a term loan, whichever way you want to do it. The company wants to do it. In 2027, this increased further. You see the problem? In this case, you require just working capital investment. There may be cases where in some years, you may not require working capital injection. These figures may be positive. In that case, money will rather be moved from working capital to operations. Now, these changes in net working capital or the working capital requirement, this is what goes into cash flow statement when we are doing financial modeling. Is these changes that goes into cash flow statement. So we are going to see it next week, how this moves into cash flow statement and affects the free cash flow calculation. Great. That has brought us to the end. So this morning, to this break period. Okay, I think someone has a question. Let me hear you.
Hello, sir. Good afternoon.
Good afternoon.
Please, the change in net working capital, how did we get the 605 for the second year?
Okay, to get a 605, we took the 554, which was the net working capital for the previous year, from the net working capital in the subsequent year. So you do it like this. You do 554,978 minus 1.16 million. Okay. So working capital is increasing. It means you require higher working capital. So the reason why it's negative is that it's a cash outflow. In other words, it's a capital requirement. You need that into the business. You need that in the business. So you require this amount. If this were to be lower than the 554, you don't need additional working capital. In fact, you actually need a withdrawal from the working capital account. Okay, good. So we are going to see this next week. We're going to see this next week. Any question? This question here, how was the inventory value calculated? Oh, okay. So there was an alternative method I used to calculate this. This actually based on some real estate work I did to arrive at something. So otherwise, the inventory days would have been part of the working capital ratios here. Just like the way we've done the receivables or the payables, inventory actually agrees with the payables because also uses cost of sales as a base. You just do the same for the inventory. But then we'll see this again next week. Any other question? Do I just take the absolute? Oh, no. I think I've responded to this. All right. So we're done with working capital. So this morning we looked at cost modeling and we look at also working capital modeling. And we talked about approach. Generally, we had to do historical analysis, and based on that, we do some adjustments and then we do a forecast. That being the model all this while. So we are going on a 30 minutes break. We'll be back exactly. Wow, I don't know that my time has really passed like this. We'll be back exactly 1 o'clock. Now, we need to get back at 1 o'clock. The reason is that we are entering into debt modeling. And I want to tell you this. Debt modeling is quite complicated in some cases. So we're going to get into debt modeling. We'll be doing some amortization. And I believe several of you have done amortization before, but then we're going to get into some interesting things. So I want to endorse that you all get back on time. Let's get back exactly 1 p.m. for the debt modeling. All right, are we good to go? Give me a comment or give me a thumbs up if you agree with me that we are getting back at 1 o'clock for the debt modeling. Hope you agree with me. Yeah. We're already gone. Yeah, good. Thank you. Thank you. Let's get back at 1 and take debt. Yeah, welcome back from your lunch break. In other words, we are all welcome back from our lunch break. I hope you can hear me, right? Loud and clear. Okay. Now, let me see by hands, those of you that know how to model debt. I mean, do amortization. Let me just see. Those who are able to do amortization. Those who are able to do amortization. Just write something in the comment box. If you know how to do, not advanced or anything, like you can do amortization in Excel. Or you've done one before. No one. No one here. At least so far in the comment section. I've not seen anyone who claimed to have done. I can. Okay. Wahab can do using the PMT formula. Okay, Justice said he can do using the PMT formula. Okay. I understand amortization from what I was taught in school. Well, I don't know what exactly you were taught. A bit of a problem for me. I can, Anthony. Okay, good. I can using the SLN function. Okay. You see, what we're coming to do today, we're going to build it from scratch. Via project finance debt sculpting. So we're going to cover something, a bit of that. So I borrowed some one or two matters from project finance to this course. So if I say I borrowed, I mean I've included them in this program as well. So we will see the same debt sculpting. We'll see it. I will just explain nicely, of course. You know, it's the most popular repayment schedule for loans. And even general loans now to corporate bodies, a lot of banks have moved to that side. A lot of banks are moving to that side, depending on the nature of the project you want to find, like PPP projects and all that. Generally, project-based projects. Projects are mainly structured in that way. I mean, the repayment of principal and interest are structured in that way. So we will be looking at it, the debt sculpting. Apart from that, other person. Okay. Let me put my representation mode. Okay. All right, so construct debt schedule for varieties of debt agreements. All right, so let's just say for a variety of terms. And the first thing, what is debt? We need to define what debt is. We are going to take it slow and slow. You know, we're going to cover a lot of things. So we're going to take it step by step. And so you have to stick with me and you have to follow all through. What is debt? Now, so if for an item actually to be classified as debt, it has to meet three criteria. Three things or three criteria must be. Number one, it has to give rise to a contractual commitment that has to be met in both good and bad times. Very important. A contractual commitment that has to be met in both good and bad times. In this case, all interest-bearing facilities are debt, just by this definition. Because with all interest-bearing facilities, you are mandated by law to repay. Whether you're doing well or you're not doing well, you must pay. Number two, that commitment usually is tax deductible. What it means is that it is taken out of operating profits before tax is charged on the profit left. And in other words, it's allowable for tax purpose. Also, it's a deductible item for tax purpose. Number three, failure to make that commitment can cost you control over the business. If you fail to pay, they could take the business away from you. Now, so if we have all these, listed here, and if you take any instrument at all you consider debt, it must meet all these criteria. So now, if that is debt, then what is debt modeling? Now, so when we talk about debt modeling, it's actually the process of projecting and analyzing a company's debt-related transactions, obligations, and cash flows over a specific period. It involves creating a detailed schedule that outlines the issuance, the repayment, and interest expense associated with the various debt instruments. That's debt modeling. Why do we model debt? Of course, critical tool for assessing a company's ability to meet its debt obligation. That's one. Understand its leverage level and evaluate its overall financial health. These are objectives you want to achieve. At the end of the day, when we're doing the debt modeling, we want to ensure that we are working towards this, or we are taking these things at the back of our minds when we're doing this work. Now, so what are the debt components in the financial statement? At least for now, I'm going to introduce more. Debt is a significant component on the financial statement of most companies. And so you can find it in various forms like long-term loans, bonds, a revolving credit line. You see, so you need to understand the different types of debt and their impact on the financial statement. Now, in this thing we are coming to do, we're going to cover some important things. We'll cover debt amortization. We'll cover interest rates, right? Different interest rate structures. We'll cover repayment planning. That's where we get some things like the debt service reserve account. But then I will not get to the detail of the debt service reserve account. Of course, I'm going to explain the principle behind the debt service reserve account. You look at the DSCR sculpting. Then we will look at debt restructuring and refinancing and the implications for modeling. All these things, we are going to be looking at them in the context of debt modeling. So there are interesting things we are going to be looking at. Now, what are the components of a debt modeling? So debt modeling actually helps to understand the impact of the debt on the financial health of a company, which I mentioned. So it can provide some insight into the debt capacity or how much debt the company can potentially take to still be okay. The repayment capability. And then if there is any risk, basically cash flow risk associated. Because if you do build the schedule, you'll be able to tell, as per the company's cash flows, whether this company will be able to pay the debt. And if it won't be able to pay the debt, then they can plan exactly how they want to go about paying the debt or structuring the debt. Maybe if they have to go back to the bank to restructure the debt. And also, with the debt scheduling, we will be able to know also the maximum of your debt capacity, and that we can know. But then we are not going to go into those matters as far as the scope of what we are coming to discuss is concerned. So the components of a debt or of debt modeling, one is the cash flows. So analyzing the projected cash flow to determine the ability to service debt. So we need to know how much cash flow is available if we are to settle the debt, and then we model it alongside. We need to understand interest. So we're evaluating the impact of different interest rate scenarios on debt obligation. So we have to look at debt interest rate structures, various structures. Then the debt structure itself, here, we are going to assess the impact of different debt structures, such as whether it's a fixed or variable rate debt or short-term or long-term or secured or unsecured. We're going to be looking at all that. Right. Okay. Now, types of debt. Now, so here, the discussion is not exhaustive. So I compare short-term debt and long-term debt. And having you on this call today, I don't have to struggle explaining what a short-term debt is and how it differs from a long-term debt. But usually short-term debt is used for bridge financing, working capital financing or whatsoever, for short-term. And long-term debt, usually for expansionary projects, right? Good. When we get to secured and unsecured, it's a matter of which one is backed by an asset or something. And also, that leads to senior debt and subordinated debt. So senior debts, they come in priority Of course, if the company is running to bankruptcy and you have to settle creditors, the senior guys will get settled first before the subordinated debt gets settled. Now, so these are also known facts. Next one, I want to compare fixed rate and floating rate debt. In fact, we're going to see it later again. Now, another word for the floating rate is a variable rate loan. For a fixed rate debt, the interest rate is fixed from day one. So even if interest rate in the economy changes, you still pay the fixed rate. So you see, in bad times, you are safe because your interest rate is fixed. But you know, if I say bad time, I mean the bad time in the economy, where interest rate is rising, yours is fixed. But in good times, when interest rate is dropping, yours is still fixed. You are in trouble. So the floating rate debt allows for some flexibility in debt payment in terms of debt cash flow, the repayment cash flows, and the interest, especially interest component of the repayment. There's some level of flexibility there. So the floating rate debt or the variable rate debt is actually, or the interest rate is structured as the sum of a benchmark rate and a margin or a spread. You look at it so. Now, so those are some few comparisons I did. Sample debt schedule. So this is a sample debt schedule. So in this sample debt schedule, it's more a summarized one. We have, or a very simple one, so to speak. We have an opening balance. At the beginning, there was no debt. This project is starting with no debt. Then there was a disbursement, a drawdown of 4 to 4 million. Then interest accrued on that amount, on the 4 to 4 million, interest of about 1.1 million. So that's the interest accrued is added to the value of the debt outstanding. That gives us 45.1 million. No payment was made for both interest and principal for that year. Therefore, the closing balance of the loan is 245 million. Usually, these things could happen. Will happen especially in projects where we have the construction phase, where there is a grace period granted by the lender to the borrower or the real estate developer that over this period, you can defer principal and interest payment. But beyond that period, you may need to make provision for payment. And all this will be stated in the debt agreement. Okay, someone asking a question, please, does this mean that interest is accrued as soon as the debt is disbursed? Oh, yes, nobody will give you debt and will not, you see, nobody will grant you loan without accruing interest from the word go. From the word go, interest is accrued as per the loan agreement. Interest is accrued, but interest may not necessarily be paid. Okay. Now, so you can see that the repayment of the principal and the interest started from the second year. So here, the entire interest wasn't even paid. So it may be, in fact, when I was creating these, the assumptions I made was that there's a 1.5 year grace period. And grace period, another term for that is moratorium period. So the moratorium period, there's a 1.5 year moratorium period, 1 year here, and the other 6 months here. So you could see that interest accrued in the second year is 1.13. However, only half was paid, almost half was paid. That's for the second half. So you could see clearly that the interest payment and the principal repayment started from the second half of the second year. In other words, the bank has allowed a 1.5 year principal and interest moratorium. Now, someone just asked a question. What about when you have a moratorium period? Now, moratorium period doesn't mean they won't charge interest. I've never seen that one before. What it means is that you will charge interest on the loan, you accrue interest on the loan, but then you can defer payments. For loans issued in tranches of, say, 1 month interval between tranches, how is the interest accrued? Okay, so interest usually in most loan agreements are accrued on a monthly basis. So if a loan is disbursed today, then we're going to do the interest calculation right from today on monthly basis. So if a month time you disburse another one, then that also follows in that order. Right? Okay. Now, that is how it's done. But at the end of this period, there's still an outstanding loan, right? This may extend beyond this period for those loans to be paid. Now, let's look at obtaining bank funding, the general matters in bank funding. So the loan application process, I summarize it generally into 4. The preparation and assessment stage. So here you determine the amount of funding you require and the purpose of the loan. Is it for expansion? Is it for working capital? Or is it for project finance? See, so ensure that the company's financial statement, cash flow projection, and credit history are in good shape, which must be done. Of course, if you work for a company like this, or you are advising a company like this, you have to assess that the history looks good. Even if it doesn't look good, is there something, can we rewrite the story going forward? Prepare necessary documents, including financial statement, business plans, and collateral details. Here, in fact, in large transactions where you require large monies to be taken, the company needs to consult a financial advisor. It may be a transaction lead, and then the transaction lead may be working alongside the lawyers. The lawyers would actually work on the loan agreement issues and to maybe if there's a collateral involved and all that, how they to ensure that all these things comply with the laws, and that if they know what they do, they may conduct a legal due diligence on the company itself and make a report available to the bank, expressing their opinion. They may need an accounting firm to provide some assurance services for the bank to be assured that the cash flows and all those information, the information memorandum be submitted to them, or even if not for the bank, the bond market, you may need accountants. If I say accountant, I mean an accounting firm to maybe provide some reporting accountant services, to provide some assurance on the historical and prospective financial statement, which the bank would then rely on, or the market where the bond is being issued will rely on, investors will rely on, right? Good. Now, so identifying potential lenders, that's the second step. So here you identify the banks that specialize in your industry or have favorable terms. Maybe it could be the banks you already work with. There are some banks that may not want to take additional positions in certain industry onto their balance sheet because that may result in them breaching their single obligor limits. So it depends. If the bank have significant sector concentration already, they may not be prepared to provide debt for such a project in that particular sector. Now, because if they do, that will increase their risk-weighted assets significantly. Of course, it can even result in regulatory distance because your risk-weighted asset get increased, your capital adequacy ratio may reduce as a result. Now, so you can approach multiple banks, request for a loan proposal and compare their terms, interest rate, and fees. Then you can engage bank representative to build rapport and understand their lending criteria. Then application and due diligence. I mentioned some issues relating to due diligence, but then the bank itself will conduct their own due diligence. So you provide detailed information as required by the bank, including the historical financial statements, business plans, and collateral. Then the bank will conduct their due diligence. They will assess the company's credit worthiness and financial health and collateral value and all that. They also have their lawyers that will handle all that. And then you discuss and negotiate the terms of the loan, including interest rates, repayment schedules, and covenants. All these understandings will be reflected in the loan agreement, which we call the facility letter. Then approval and disbursement stage. Once the due diligence is complete and terms are agreed upon, the bank's credit committee then approves the loan. Everything, they will ensure that they tick their boxes. The reason is that they don't want to increase their non-performing loans. That creates concerns because if they give a loan and the loan goes bad, what happens is that they may have to defer interest accruals, or they may have to defer accruing interest on those loans, and that is affecting the bank's revenues. Now, then they execute the loan agreement and related documents, ensuring all terms are clearly understood, and the bank disburses the loan, which the company can then use for its intended purpose. This is general procedure run by most banks. Now, That is there. Now, so what are the concerns of the creditor giving out the loan? You see, you may be thinking that maybe a modeling class, when we get there, we put ourselves down and say, oh, there's a company taking a loan of so and so, blah. It doesn't help. You see, those are more theoretical. That's rather theoretical, right? It will be difficult for you to really appreciate it in practice, because in practice, there are a lot of factors that are influencing what you do. You see, how you go about amortizing the debt is a matter of the agreement between the company and the bank. That's the reason why, if you're working on things like debt amortization, you must always resort to the debt agreement, what was agreed, because the agreement will influence how the debt should be amortized. Now, so what are the concerns of the creditor? The creditor largely is concerned with 4 things: the financial health, collateral issues, credit history, and management integrity. These are the 4 matters. Now, the financial health concerns and collateral are issues relating to ability to pay. And credit history and management integrity are issues relating to willingness to pay. You see, you could have, if we talk about ability to pay generally, is the strength of your cash flows, right? The strength of your cash flow. If your cash flows are not good, then they need some good collateral. Now, you can have that, but then the question is, people can have money, but they will still not pay, right? So the question is, will the company pay? Will the company pay, even though they are in good financial health, but are they prepared to pay? The willingness to pay is a behavioral issue. Okay. So when we talk about the financial health concerns, you need to do some health check. You look at the operating cash flows, EBITDA levels over time, their current gearing. Do they have existing debt? Because if they have existing debt of which they make interest payment, then what it means is that if they take on this new loan, then it means that there's additional leverage. The question is, the existing debt, will they be able to use their cash flows to cover the debt service, even to have enough again to extend to the new debt? So the debt to equity ratio currently is very important for you to know. Then the interest coverage ratio. We will look at these things. Again, for collateral, you see, the bank's major concern is not collateral. The bank's major concern is the strength of the cash flows. It is when the cash flows fail them, that's where collateral becomes a key thing. You see, now credit history, we're looking at the company's payment history and credit score to assess the reliability in meeting financial obligations. You see, so you can check references from other lenders and suppliers. Now we have the credit bureau that can provide some information on that. Now, so management integrity plays a key role as well. You need to evaluate the credibility and track record of the company's management team. So this is more of a reputational issue. You can analyze the company's strategic plans. You see, in the strategic plans and the business model, you can judge willingness. Are they okay? What's their perception about the future? What's their plan going forward? Is their plan more of expansion and cash flow generation? You see, that will, because people can produce figures and tell you that we'll pay. But at the end of the day, is the plan consistent with the cash flow projections? Okay. Now, then why financial projection in debt planning? Why financial projection? You see, when we do financial projections like we're doing, the reason why the banks will say, bring a cash flow forecast and all that. Why do they do that? You see, and when companies too are doing these financial projections, of course, it can be just to take a loan from a bank, but there are more uses to the financial projections than just that. You see, with financial projection, you can determine your maximum debt capacity. You know what's the maximum debt you can take and still achieve your objectives, your financial objectives. Then also, cash flow planning, of course, is ensured that there is sufficient liquidity to meet the debt obligation by forecasting the P&L, the balance sheet, the cash flow statement. You can calculate the cash flow available to meet debt service and whether you have enough liquidity. And also, you can evaluate repayment schedules, okay, to see whether the repayment schedule the bank has given you is something you can meet, or you think you have to renegotiate it again. That's why the first step perhaps will be for you to start by doing your financial modeling and all that, project your financial statement, take an initial interest rate as a starting point, and then use that as basis to negotiate with the bank. That look, with this interest rate, this is how the cash flow is looking like. We think this one will work for us. Then use that to negotiate. You don't go to negotiate with the bank without doing financial projections. No, you have to do that at home. Do your work and see which one works within your cash flow strengths. There's supporting strategic decision as well. So it informs management decisions on capital structure, investment, and financing strategies. Now, so identifying risks is a key thing too, of course. By doing the financial projections, you can do some stress testing. Look, you do scenario analysis and stress testing to see if there are significant changes in the business. What would be the implication on the cash flow? On the cash flows, can we still make the debt repayments? And also, it enhances creditor confidence in you. And it makes them realize you are serious. You are prepared. You don't go to a bank without any cash flow projection and you just say that I want a loan. Okay. That is it for the process. Let's get into facility letters, understanding facility letters. Now, so when we talk about facility letter, is actually a formal agreement between a lender and a borrower, outlining the terms and conditions of a credit facility. Yeah, I'm focusing a lot on the bank side, the bank loans, right? Now, so there are some key components to this. So the loan amount is likely to be part there, the loan amount and type. So it details the principal amount and type of credit facility, whether it's a term loan, a revolving credit. These are key things that will reflect in the loan agreement or the facility letter. They also specify the applicable interest rate and how it is calculated. Will be clear whether it's a fixed rate or it's a variable rate. If it is a variable rate, the benchmark they are using, the benchmark rate they are using, and specific benchmark rates that they are using and how it should be calculated. Repayment terms. You see, the reason why these things must be clear is that in case the borrower fails to pay and you take the borrower to court, you have something as evidence that this is the agreement we had. So you have to read your credit agreement before signing, right? Some people are in hurry, they just sign agreements and commit to the company, then later the company gets into trouble. Now, so repayment terms are also part. So we align the repayment schedule, including principal and interest payment dates. Sometimes the repayment schedules are included. Sometimes they will just define it. Covenant. So it includes financial and operational covenants the borrower must adhere to. We'll look at covenants soon. Then fees and charges. So other related fees like penalties, late payment penalties, blah, 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 and all those commitment fees are all outlined in there. There's security. So it describes the collateral or security provided to the lender. Yeah. Good. Still on the theory. But then setting a context. Now, when we talk about debt covenants are actually contractual provisions included in a debt agreement. It outlines specific requirements and restrictions that borrowers must adhere to. It's covenant. Now, it has some importance to the lender. Number one, for the lender, it acts as a safeguard for lenders, ensuring that borrowers meet certain financial performance and stability benchmarks. There are things they will allow you to do. There are things that you won't be allowed to do. Now, importance to the borrower here, the debt covenant actually provides opportunity to demonstrate discipline and creditworthiness, okay, which can lead to more favorable borrowing terms in the future. So failure to comply with covenant requirement may result in penalties, right? Higher interest rate or even defaults, which you don't want to see. I think I made a mistake and I put the CCC there. Now, so we need to get the debt covenant incorporated into the debt modeling. Very, very important. Because in a covenant, they may state some specific ratios you shouldn't breach. And we're going to cover some of these ratios. Now, so when you are doing a debt modeling and financial modeling, you must assess if those ratios are likely to be breached and ensure that they are not breached as per your projection. So if you work for a company, the board or senior management team can only sign the budget if those objectives are achieved. Those objectives must be prioritized as well. Now, so there are some common debt covenant requirements. Of course, like financial ratios like this, debt service ratio and other leverage ratios, like you shouldn't breach them. Capital expenditure restrictions, you may be restricted from using funds to invest in more capital expenditure, especially maybe early part of the loan. But then if they realize that the capital expenditure is a necessary one, which will actually, if not done, could affect the company's future cash flow, of course, over the debt repayment period, it may be necessary. Minimum cash balances. Yes, so there may be provisions where you must keep a minimum cash balance in your account. And we will come back to that when we deal with debt service reserve accounts. Now, dividend restrictions may also be there, that you can't pay dividend until you are done. You see how financial modeling can be complicated, because all these objectives must be achieved in a model. Then change of control clause. So some debt covenants include provisions that trigger in event of default. So if there's a significant change in ownership or control of the borrower. So if, let's say, we have the parent company selling off the subsidiary, and there's a subsidiary that have borrowed, of course, since it's been sold to another buyer, that becomes a credit event or a default event. Good. So far, any question? I could not find any question here. Okay. No question here. Now, let's move to forecasting debt capacity or requirement. And this is where we will start saying some. Okay,
Please, I have a question.
Yeah. Let's hear
good afternoon, Julius. Please, I work in a company and it's a subsidiary of a parent company. And so if the subsidiary gets loan from the parent company, and what are some of the covenants that will be required? Because I've been asked to work on a loan repayment schedule that our subsidiary company took from the parent company. And it's supposed to be paid within 1 year. So I'm looking at intra-transaction in terms of loan between a parent and a subsidiary. How is treated in the books? Thank you.
No, okay. Are you looking for the accounting implications or the issues associated with failure to pay? If you can be clear.
The accounting implications.
No, of course, the accounting implications, if a loan from a parent company to a subsidiary, on a subsidiary separate financial statement, you are going to be treating the loan as just as the loan taken from any outsider. Of course, you specifically mentioned that this is a loan from the parent company. But then on a consolidated basis, those are intra-group items or transactions. Therefore, that have to be eliminated when a group account is prepared. Of course, the interest component of the loan, the interest you paid on the loan amounts of the balance sheet will all go off when we consolidate things at the consolidated level, because the company itself cannot borrow to itself or be lending and borrowing to itself at a consolidated level. But then, when we are looking at the standalone financial statement of the subsidiary, that loan is going to be treated just like a loan you have taken from any other lender out there. Now, when it comes to the ratios you should be monitoring, we'll be covering some soon. So just stick with me. I'll get into that. Now, forecasting debt capacity or requirement. Now, depending on what you want to do, that determine how you intend to determine the amount of debt that you may need. The approach may differ depending on what you're doing. Now, but critically, this is a key matter because debt funding or debt finance actually thrives on ability to pay. Ability to pay is a matter of cash flows. So if we get the cash flow, suppose this is a project. If we get the cash flow over the life of the project, we can determine what the maximum amount of debt could be, where we'll be able to meet those kind of debt services. Now, for corporate finance engagements, with these, the company can borrow money to finance something, but then the source of the debt service or where money will be gotten from to reservice the debt may not necessarily be that particular item they've invested in. So that's one thing with corporate finance. In fact, a subsidiary can actually borrow money from a bank, but the parent may be the one repaying the money. That happens in corporate finance. But when it comes to project finance, it doesn't work like that. The debt must be serviced from the project cash flow. It must be serviced from the project cash flow. That's why projects are structured as an SPV, a special purpose vehicle, right? Now, so in the context of projects, you must be able to determine the maximum amount possible you can take as debt, such that you are still within the framework, or you are able to repay the debt. So you project the project cash flows, but then based on this cash flow, how much possibly can I get as debt? Something like that. Great. Now, there are three major approaches to determining the capacity. So we can use a top-down, we can use bottom-up, or we can, and then a combination of the two. If you have been with me, realize that I've been talking about this top-down, bottom-up, and the hybrid. Before I go, someone asked a question. The network is unhelpful today. Oh, Gilbert, sorry. Okay. All right. So for the top down, you start with an overarching macroeconomic perspective by considering prevailing interest rates, economic growth forecast, industry trends, and market conditions, right? Then we assess general availability of debt in the market. The question is there enough liquidity even in the banking sector here? That's why for major projects, there must be a syndicate. The banks pool resources together and then finance that customer. Because a single bank may not risk taking that whole liability, that whole risk onto their balance sheet. That may be too difficult. Because if that may increase the single, that may exceed or may breach the single obligor limit of the bank, right? But then if several banks come together in a syndicate to finance these, then the risk is distributed across, right? No single bank is absorbing these on their balance sheet. Okay. Now, then you then assess the general availability of debt in the market, then assess the company's specific capital requirements, such as maybe for some expansion project, acquisition, or working capital needs. Now, then based on this analysis, you arrive at an approximate amount of debt a company may need to contract to finance operations or growth plans. Now, of course, this is in the context of corporate finance. Now, for the bottom up, this will involve detailed analysis at the company level. Now, so here, you should review the company's investment and financing policies and examine the financial statements, cash flow projections, capital expenditure plans, and working capital requirement. Or in other words, what you do is that you construct an investment and financing plan. So if you have an investment and financing plan, it shows the investment requires in fixed assets and other assets. Then you ask yourself, so how do I fund this investment over a timeline drawn, right? Now, so do not forget to discard any findings from your analysis with senior management team before conduct or concluding on your estimate of your company's forecast debt requirement. Because there may also be existing debt, or maybe there may be a facility letter now that has some covenant that prevents you from taking additional loan. Or by doing the financial projections, then you put in scenarios. Okay, if we take a debt of 10 million, what will be the impact on the financial statement? But then just not the financial statement, the impact on some critical ratios, right? Like interest coverage ratio, then debt to equity ratio, operating margin, maybe EBITDA coverage, EBITDA to interest expense ratio. Like you have your ratios calculated. Now, so you ask yourself, if I use 10 million, this is the result of the cash flows and the ratios. If I use 50 million, this is the result of the cash flow. So which one do I think will work well for us going forward? Which one can we defend before the bank? Or then we can use a hybrid. So, in fact, most analysts will combine the two. The reason is this. You can use the bottom up to determine your requirements based on your needs, internal needs. Then the external environment will determine whether the banks have enough liquidity and even whether you can get that as a cheaper interest rate. These are the top-down considerations. Now, when you put the two together, you get a hybrid and you get a very good analysis done at the end of the day. Okay. Now let's deal with this question. For Lars Homes Limited. So Lars Homes Limited is a renowned real estate company. The questions today, the scenarios today, some of them are very heavy going forward. These ones are simpler. So I need your involvement, true involvement today. So Lars Homes Limited is a renowned real estate company in Ghana known for its expertise in developing high-end apartment buildings in prime locations. Recognizing a growing demand from the diaspora for luxurious apartment in Ghana, the company has acquired a large acre of land in a prime location to construct a 50-unit apartment complex. To finance the project, Lars Homes plans to secure 80% of the required capital through debt financing, while a private equity firm has shown interest in contributing 20% equity. You see what's happening? We have 80%, then we have 20%. The total projected cost for the development of the 50-unit apartment complex, as estimated by the company's cost engineer, is 200 million. 200 million is the total cost. Don't forget, the total value of the project, we want to get 80% in them. So this is the construction cost, 200 million. Now, for the project's smooth operations and contingencies, Lars Homes anticipate working capital requirement of 10 million. So working capital requirement of 10 million, a project construction cost of 200 million. It gives us a total of 210 million as a total project cost. The construction period lasts for 5 years. Okay. Now, the project manager estimated the various stages of completion over a 5-year period. And all these things are practical stuff we see every day. I've done a lot of work in real estate. And these are the practical scenarios that play out. And I've been in consulting for some time now. So I've met several scenarios similar to this that we have to model, right? Now, so if we look at this, the percentage completion. So by 2024 ending, you expect to complete 10%. Then that will increase to 30% in 2025. Then that will increase to 55%. So if you just look at it, you realize that 10% work will be done in 2024, 20% work will be done in 2025, 25% work will be done in 2026, and 2027, 25 again, then 2028, 20% will be done. So at the end of the day, you have 100% work done by 2028 in terms of the construction of the 50-unit apartment complex. Now, the private equity firm agreed to spread its contribution equally over the first 2 years. Over the first 2 years. Now, the question is, how will you estimate the debt funding requirement for Lars Homes over a 5-year period? Now, let's do this work. I'm giving you, I have to be monitoring the time today, right? I'm giving you 10 minutes to handle this. Okay, let's do 7 to 10 minutes. 7 to 10 minutes maximum to handle this. Great. I hope you are there. Let's do that quickly, guys. 7 to 10 minutes. Let's calculate let's estimate the debt funding requirement. You see, the key thing is that you don't want to go and take money and put down. It's not nice. So usually you get into contract with the bank, and then you pay some commitment fee so that the bank can make the money available as and when you need it. So I want you to do this work for me. So let's calculate how much funding we need for every year. How much debt funding we need. Now, so it is now 1:52 GMT. Let's be back 2 minutes past 2 GMT. Yeah. Let's be back 2 minutes past 2 GMT. Thank you. Let's get that done.
Ah, ok, c'est le développement créatif. Ah, ok. Mais moi, je ne pas tout à fait. Ah, ok, c'est là, je pense. Ok. Oh, ça va être ouvert.
was finished. Daniel has done his. What is from Daniel? Okay. Okay. This wonderful. This wonderful from Daniel. A great work done. So let with a minute more, then we okay. So it's time. Let me check what has been done. So let me project that of Daniel first. Project that of Daniel. So I hope you can all see Daniel's work. And so 2024, 25, 26, 27, 28 funding means. So as per the question, the understanding the company has is that they want to get a debt of 80% and an equity of 20%. So the total construction cost or project cost is actually 210, which is made up of construction cost of 200 and working capital of 10. So 80% of the 210 is 168, and 20% of the 210 is 42. So when we add the two, you get a 210. Yeah, great so far. The project completion, 10%, then that increased to 30, increased to 55, to 80, and by year 5, they are done constructing. So the differentials, then additional work of 20 here, additional work of 25, additional work of 25, then finally, additional work of 20%. Okay. Now, so the funding required accordingly, so 10% of the 210 is needed here. That's 21. Here, 20% of the 210 needed here, that's 42. 25% of the 210 needed 52. That's all this also correct. Now, so when you sum up all this amount, 21 plus 42 plus 52.5 and all that, you get the 210. Then the equity funding, we were told that the PE firm will bring in the money or spread it equally over a 2-year period. So they are bringing in 42 million. If we spread it equally over a 2-year period, that's 21. Then cost to be funded by debt. The cost to be funded by debt will be the differential. Here, in the first year, we need 21 million. So the PE firm's initial 21 million will cover that. In the second year, we need 42 million. But then PE firm will be bringing their 21 million. And so we need debt funding of 21. In the third, fourth, and fifth year will be entirely debt. So now, we now know the debt plan, how much debt we required for each year. Year 1, we don't need debt. Year 2, we need 21. Year 3, we need 52.5. Year 4, we need 52.5. And year 5, we need 42. Great work. Great work. Let me look at others as well. Olayinka, total debt required is 168 with 42 million contribution from equity. Okay. Great. Then, okay, Olayinka, I think you've done the work as well. Okay, great work, great work, great work. I love the energy you putting into this. Is commendable. Let me look at the next one. I don't know why I can't get the. Just a moment, guys. I'm trying to get the. Okay, the chart was. Okay. Who else put something here? Total debt is 170. Okay. Oh, Isaac, you deleted yours. Okay, you may come back again if you want to. All right, let's continue with the lectures. There's some few more things I want to mention. Very, very important items here. Thank you. Now, so let's move on. Let's move on. Now, let's get into debt amortization. So, an introduction to debt amortization. Now, so there are several methods to amortizing a debt, right? And for me, I don't want to really spend so much time on some of these things because the examples are there for us to get into. But then this is a sample debt amortization schedule, a sample amortization schedule. Let's look at that. Now, this is a point. They are taking a debt of 44 million, and the disbursement date is 1st of January 2020. Right? Then the interest paid is to be set at 2.5%. The tenor of the debt is 30 years, and the grace period given for both interest and principal repayment is 1.5 years. I think someone put a chart there. Oh, more people did the work. Isaac did that. Oh, great. Thank you very much, Isaac. That's a great one. And God's love too did it. Oh, thank you very much, guys. Thank you very much, guys. I love the zeal. Thank you very much. Saying that. Now, so these are the information given. I'm showing you this before we go ahead to do it. Oh, Anthony too has done it. Thank you very much, Anthony. I love this energy, and I want you guys to sustain this energy through all the modeling we are going to do this afternoon, as far as debt is concerned. Don't be worried if you get it wrong. No, we are here to learn. So we ask all the questions you want to ask. Now, so the debt amount is this, the disbursement date is this, interest paid, our interest rate is 2.5, the tenor of the debt is 30, and then the grace period, I think I made a mistake in writing the tenor like this, right? The grace period is 1.5. Now, look at it this way. You'll see clearly that in this column, I have years. In this column, I have months. We are going to do a sample of work, but then I want to show you this, that I want you to understand what is happening here. So when we start doing ours, you are not found wanting. Now, this amounts, and here we have the opening balances. So for example, the 44050,253 here is the opening balance here. Then we accrue interest on the opening balance. And how do we determine the interest? All interest are stated in annual terms, unless explained otherwise. All interest, unless you are told that it's a monthly interest, all interest are quoted in annualized terms. So the 2.5% here is an annualized interest rate. So if you got to take the 2.5 and you divide it by 12, you take the 2.5 divided by 12, that gives you the monthly interest rate. That is what you use for the calculation of the interest that applied on this. Now, we were told that there's a moratorium period, which is a grace period here. We're told of a moratorium period, which is a grace period here. Because of that, over the moratorium period, there's no interest payment. And also there's no principal repayment. So both interest and principal are covered under the moratorium. So you see that the debt balance will keep growing, just adding the interest accrued to the debt. And the debt balance keep growing. So you have the closing balance. Now, we're told that the moratorium period is just for 1.5 years. That is 18 months. So by the 18th month, we should exhaust the moratorium period. Then we can start making interest and principal repayment. So from the 19th month, you see that interest payment has started and principal repayment has also started. And then we have the closing balance again, running like that. So that is how amortization works. The other matters here, these last 3 columns here, I placed them here for ease of transferring my work to the P&L and the balance sheet. Usually what I do is that I have this cumulative interest accrued. It gets the interest accrued. It accumulates it over time, right? The cumulative order. The principal repaid, same thing is done here. And the cumulative interest paid too, same thing is done there. That's what I do. So you could see that over the period that no principal was repaid and no interest was paid, these areas were entirely zero until they started paying. It started accumulating it. I'll explain to you why I'll have to do it this way. But there's a question in the chat box. Oh, wow. Wow, wow. I love them. Look, let me just show, just for fairness, let me show you everyone's own, so that those online too will follow exactly what's happening. So this is coming, someone's work, and that's quite great. And let me see somebody else to, sometimes if I do this and, okay, so that I can be able to see. All right. So so the one I've just showed is from Olayinka, and also Godlove Otu also presented his own in the third year. Isaac too did, Anthony did, Angela did, join the guys. Then Uche also did. Wow, so much work. Just picking some random to share. So much energy placed into this. Thank you very much. That was a previous question we just solved. Now, so just explaining to you the amortization, right? Amortization schedule. Let me take up this from here. Now, so if I accumulate the interest this way, look at it like this. In 2020, the cumulative interest accrued is 1.1. You see, it's 1.1. So that's the total interest for the year. But in 2021, that the cumulative interest accrued round to 2.2 million. Don't forget that also includes the interest for 2020, because this is a cumulative interest. You get a point? Now, so if I take the interest accumulated by the end of 2021, and I take out the interest accumulated by the end of 2020, then the difference becomes the total interest accumulated in the year 2021. And that difference goes into my P&L. So instead of me writing a formula to sum up things in between the boxes, I can just take the ending balance for cumulative interest accrued and then subtract the ending balance for the previous year. Then I'm cool to go. Now, I will do the same for the principal repaid and the interest paid, because the interest accrued goes into the P&L account as interest expense. The principal repaid goes into the cash flow statement, and it also goes to reduce the debt. Okay, let me take my words back. Then I'm going to talk about that one too. The principal repaid goes into cash flow statement, and the cumulative interest paid goes also to cash flow statement. The closing balance at the end of every year, the ones I've bolded here, the closing balance go into the balance sheet at the end of the year. All right. Now, basic input into amortization workings. Now, so into amortization workings, we have the loan amount will go into the workings. Interest rate, we need interest rate. We need the loan term or the tenor of the loan. Then we need a repayment frequency. A loan repayment frequency. Is the loan going to be repaid monthly? Is he quarterly? Is he semi-annually? Is he annually? You know, we need the moratorium period, if any, or the grace period, if any, and clarity on whether the moratorium period covers interest only or interest and principal. Okay. Now, there's a question here, and we are going to do an amortization. Now, this for the same loss homes. So we'll do the amortization. Now, we determine that the loan this loss home should take is 168 million. That was what we determined. Now, let's look at it. Loss Homes Limited has made significant progress in their pursuit of financing for the high-end apartment building project. After a successful meeting with Fidelity Bank last week, the bank has expressed keen interest in financing the project, subject to certain conditions. To move forward, Loss Homes has been tasked with submitting detailed project plan, market study report, and financial projection for the loan application. Of course, that's what we see. Now, initial loan terms from Fidelity Bank include the following. Loan amount, 168 million, the total loan required, which we calculated on the previous question. Interest rate is 10% per annum. Moratorium period, 2 years, principal only, meaning that the company, when you pick up the loan, you should be making interest payment right from the time the loan is taken. But then they'll defer principal for 2 years for you. Then loan term, 10 years. And the repayment structure is on monthly equal installment. Right. Now, debt covenant. There's some debt covenant here. Debt coverage ratio of 3 times and minimum debt to equity ratio of 70%. At least for now, that will not affect our work. Disbursement as per the project plan. So we know the project plan. So because we know the project plan, we know how much they need every time. Now, the question is, you have to amortize the loans as per the information provided and construct a debt schedule to be incorporated into the financial projections that they have to send, because they have to send a financial projection. So you need to come up with the initial debt terms and incorporate them into the cash flow. Let's see how the cash flow is able to absorb them. But now we are dealing with the amortization. Good. So knowing the facts we have here, a 10% per annum, a moratorium period of 2 years, principal only. Let's get into it. Now I'm going to unshare my screen and then open my Excel. Okay. So amortization, let me just, so that I can see some of these things here. Just a minute so I can be more effective. That's what I do. Okay. Let me get a workbook open, right? That's what I'm trying to do. Now, let me share my screen so that you see what I'm doing here. Share my screen. This is my Excel. And so you can see my screen now. So let me take away the red lines. I don't know why. Try to, these things are overshadowing my Excel. Okay. So you go to view and take off grid lines. Let me also, we push this back now. Okay. So in the question, let me just lift the project plan, the project completion plan, right? Whichever we want to call it. Let me paste that here. And so you can see my screen clearly. Okay. Okay, good. So we know that from the workings that we did, right, that the construction cost, or just maybe based on the work done by others, let me just pick the amounts that we need. So let me just pick the amounts that we need. And I'm going to use just one of them to demonstrate how the amortization is done. So let me pick someone's work. Just one. And then I use that to just demonstrate this to you. Okay. All right, so we have 21 million, 52.5, 52.5, 42. So 21 million. Now, this is the point, right? Even though the total amount we actually need is about 168 million, as we have. And we want to take that money over, or as per, or the disbursement of the money should happen as per the project plan. So 10% of that money will come in 2024. Then in 2025, we expect 20% of that money. 2026, we expect 55%. 2027, we expect 80%. 2028, then, what am I saying? 2025, we expect 20%. 2026, we expect 25%. Same thing for 2027. And then last year, we expect 20%. That's what we want to do. But then we know that the project cost is 168 million. Now, what I'm going to do is that there are a series of loans that will be taken. But then, just for simplicity's sake, and the objective is to show you how the amortization is done, I'll just do the amortization on the whole amount for you to see. So this is the project cost in thousands. Okay. Project cost in thousands. So usually for me, what I'll do when I handle amortization and all those things is to start with the years. So I have my years here. And the next thing I'll do is that let me increase this so that I can see. So I'll start with the years, then I may do months. Then from month side, I may start looking at the interest rates, right? Also, let me just build this well so that at the end of the day, it becomes reusable later. So days in months. So in the number of days in a month, I'll be calculating that. And the next thing I'll be calculating will be that of the days. I'm showing this because there's something I'm going to add to it later when we come to amortization of floating rate loans. That's why I'm doing this at once. Days in year. So I have the number of days in a year as well. Then I can start talking about interest rates. So benchmark rates. Benchmark rates. Then I can look at the spread over the benchmark rate. Then I combine it in interest rates. I love to do my things in a vertical order, right? From here, I have my opening balance. Then I have interest, let's see, additions to the loans. Then I have what I call the amortizable debt, or the amortizable debt, or amortizable debt. Then from here, I have interest accrued. Interest accrued, then interest paid, then I can have principal repaid. Okay. So I'm going to do something like this. This is what I'll do. Sometimes my laptop could just be messing up unnecessarily. I don't know how. I need to be able to move this to a point where I can access all my tab. Then let me move it here. Okay. All right. So maybe let me just color these bits and then make this white automatic. And just white in this order is fine with me. Okay. So let me wrap and center and all that. And yeah, there are more efficient ways you can handle some of these things, but then I'm taking things step by step because I want you guys to follow me. And those of you who are doing this thing for the first time, so you can appreciate what we are doing. Okay. All right. So then maybe let me put this in the middle. Something like this is fine. Now, so the years in question, before then, I would like to summarize my project features or my debt features here. So the principal amount, so principal is actually equal to the project cost. As I told you, you want to do things on this basis. Then secondly, I want to get the interest rate. I'm creating this sheet now because it's going to be reusable later when we deal with other things. So I don't have to always go back to start all over again. Then we have the tenor of the debt, and we have the moratorium period. Now, the interest rate we were given in the question, I try to open the question down so I follow. So we're giving 10% interest rates, 10% interest rates, and we were also, the tenor of the loan, that actually is 10 years. So 10 times, since this is going to be amortized on a monthly basis, 10 times 12, that's 120. A moratorium period, we're told 2 years principal only. So 2 times plus 12, 24 months principal only. Just going crazy on this. So principal only. Okay. Now, so, well, we can have the months. So what I want to do is that I need to also put here the disbursement date. The disbursement date. So I can say maybe let's do January 2025, or let's say 24. January 2024. Let me change my this thing here. Let me custom the date side. Special dates. I need something. The types of quite needing here. Not quite getting. I think this is not bad. Let me use this. Okay. Now, so if I come here, all I have to do is to do this. Let me use the EO month function, the start month, then +1. That'll give me that of the next month. I have to know why I have to do all these dates things, and sometimes it's annoying. Eh? I can do it this way, or I can just do the short dates. I could actually format it further, but then there's no much time to be doing all that. So while I need this over a 10-year period, so let me move this to this. I need this over a 10-year period. So one thing also I do here is that I can start numbering from here. Since I'm dealing with 10 years, I'll do just up to 120. So I have my workings here up to 120. Okay, 120 day, 120 months. That gives me the 10 years I'm looking for, right? Okay. So I do that. And days in a month is basic. It's just a matter of taking this month and subtract the start month from it. And of course, hey, see what's giving me. I think I have to work on these dates, and make it rather 31st. Or start the first one, comma 0 instead. Okay. So the rest follows. Okay. Okay, things are working well for me now. So 30 days, and the next one will be this date minus the previous date. So you give me the number of days. And the reason why we have to do this is this. Guys, let me explain. You see, in some project document or in some loan agreement, the calculation of interest rate, there's a date conversion to it, or a day count conversion. Okay, so a conversion in terms of how the day count should be, whether it should be 30 by 360 or 30 by 365, all those things could be included in a loan document. You'll see Samsung. Now, so these are a number of days in a year. And I will also want to just assume that for the purpose of what we're doing, the number of days in a year is 365. And these are the days in a month. Now, so benchmark rate, then spread. But here we are dealing with the fees rate. Therefore, we are going strictly with the fees rate. So this is the rate. That's going to be 10% fees. So I can actually log this. I can log this so that it doesn't change. You know, to make it relative. Absolutely, sorry. Now, so continue with what we're doing. The opening balance is 168. We have it here. Now, if there's any addition to the debt, we add it to the opening balance to get the amortizable value of the debt. Okay. Now, so is the amortizable value of the debt that we're going to calculate the interest on. So how do we calculate interest? Now, let's just assume that the day count conversion we are using is 30 by 365. Now, the actual number of days in a year is 365. So if we say 30 by actual is just to say 30 on 365. We also have 30, 360. That's 30 by 360. But usually you see a lot of time people doing 30 by 365 or actual by actual, meaning the actual number of months, actual number of days in a month divided by actual number of days in a year. So here, what I'm doing is actually actual by actual. So let me put that even here. Okay, date of loan acquisition. Let me link that. And also let me add here day count. The day count I'm using here for the purpose of the work I'm doing is actual by actual. The actual number of days in a month divided by actual number of days in a year. That's what we're doing here. Actual by actual. Now, so how do we calculate the interest rates? It's basic. It's a matter of taking the actual number of days in a month divided by actual number of days in a year. Then we multiply that by the interest rate in question to determine the monthly rate. Then we multiply that by the amortizable value of the debt. And when we hit enter, it gives us an interest accrued on the debt. Now we're told that the repayment, the moratorium is only on the principal. Since it's not on the interest, guys, I hope you can see my screen, just to confirm. Okay, someone wants me to slow down. Yeah, we can. Okay, I'll slow down. All right. So, you see what is happening? Just highlighting my formula. So, it is days in a month divided by days in a year multiplied by the interest rate. That's giving me my monthly rate. The monthly rate or the rate proportional to 30 days out of 365, right? Then multiply by the amortizable debt. Then I get my interest accrued. As per the question, the moratorium period is only on the principal. It's principal only, 24 months. So since it's on principal only, it means interest payment must start now. Just negate this accrued. Then you get an interest payment paid. Then I think there's one step left I've not done, which is the closing balance. Okay, closing balance. Now, for the principal repayment, no, we are not doing it. We are not doing it because we were told that the moratorium period is 24, principal only, 24. Okay, good. Now, let's do that. So, to calculate this, we have the amortizable value of the debts plus the interest accrued plus the interest paid. I'm adding the interest paid because the interest paid already have a negative sign by it. So plus the interest paid, right? Good. Then I'm going to make the principal repaid also negative. So we just add that as well. And that gives us this value, 168. You see that the principal is still left untouched because we are just making interest payments on it. We charge the interest, we pay it, so we are left with the same principal. So this moves to the next month. So we move it to the next month. And then we do the same. So going forward, we do the same. So I can just drag. Sorry, I supposed to drag from here. So I can just drag. I drag this. So I just move this and also drag. And also drag. Now, the principal is left unpaid. The principal is left unpaid. So in 120 months' time, which is 10 years' time, you still have the principal here. It's still here unpaid. Now, so let's deal with the principal. We're told that there's a moratorium on the principal. So let's address the issue of principal moratorium. The moratorium is for 24 months. The moratorium is for 24 months. So there are two things, there are some few things we can do. We can write an if statement for this. I can go here and say, okay, let me just look for 24 months and track it. The 24 month and track it. But then it's not a better way of doing this. Let me show you what you can do. Let's write an if statement. It goes like this. So if, let me use the if error so that if there is error, it handles it. So this is what I want to do. So if this 24, okay, or if this figure here is less or equal to 24, so it's less or equal to 24, if this figure here is less or equal to 24, which is this, if it is less or equal to 24, I want to log the 24. If it's less or equal to 24, then do not make principal payments. Because you can only make principal payment after the 24th month. So as long as you are within this region, you are less than 24 months, no principal payment. Okay. Now, so if this is less or equal to 24, comma, then make 0 payment or no payment. The value is 0. Otherwise, you make a principal payment. And how much principal are you paying? Now, the amount of principal you are going to pay should correspond to, I can write further statements that, or where I'll have to include offset function, where it will know exactly the kind of principal to pick. But for simplicity purpose, next week I'm going to complicate things, but then for simplicity purpose, let's just go and pick the exact amount of principal we want to amortize. Amortize this. The reason why this is simpler is that here, the moratorium is not affecting the interest payment. If it were to affect the interest payment as well, I can just simply go to pick this. Okay. So I log this. And I say that if that period is exceeded, then what you do is that you pick this principal and divide it over the remaining number of periods. And what is the remaining number of periods? It is the 120 months we have minus the 24 months that I've just passed. So the remaining period available for debt amortization. Now, I need to log them so that when I move the formula, things don't change. You know, the analysis I'm doing doesn't blow out. Okay. Enter. What is missing? Oh, okay. If this, otherwise this. So there's nothing missing. Okay. There's one parenthesis missing. Okay, I think I've resolved it now. Oh, you've entered too many arguments for this function. Well, let's look at it. Where is it coming from? So if this is less than this, otherwise this. So what do they mean by too many arguments for this? Let me organize this in this function. Let's see. What is the problem with this simple work I'm doing? It's coming to create problem. If error. Oh, okay. I get it. If I'm given an error, I'm not just using a simple if statement. So because I'm doing the if error, I need to add another thing to it. So if error, I'm supposed to have put this in a bigger bracket so that then otherwise you do non-applicable. Okay, so if, just a moment. So if this is this, then otherwise this. This should work. Good. Now, because this must be a nested if, I have the actual argument is executing in this, but I want to say that if there's an error in my work case, it should blow out by giving me the if error this. Do I even need if error there? Sometimes it's just kind of like complicating things for people. Now you see what's happening. You see that I didn't go to the 25th month to do this. Let me show you this to the right side or the left side. So you see the month in which it started. It started in the 25th month. You see, because of what I built in there. Now there's a question. If error or if, okay. I think we need if rather than if error. Yeah, I can use only if. Yeah, you will have to use your if or if within the error. Yeah. Good. Thank you very much, Alayinka. I missed up on that, and that's exactly what I did, and I got it right. All right. Now, let's see whether we will be down, the amortization will be completed. Now, one mistake I made was that I should have added a negative to this. So I'll add it inside the if. I'll not add it outside. I'll add it inside the if. So then I drag it down. And here I must get things in negatives. And then you see what happened. The closing balance of the loan in 10 years' time is 0. That's my objective. So here what I've done is that I was paying the principal in equal installment of principal, right? Good. So this is the amortization. Done. And I'm going to share this worksheet with you. You will upload it to the portal. Okay, good. So this is more of a fixed rate loan. Any question? I'm not sure there's any question. So quickly, these are the simple amortization. I've just shown you a simple amortization. Let's get into it further. Now, show my screen. I'm not sure I closed that. Why is C off? Oh no. Let me just be saving my work so that what's happened to me last few days does not happen again. Okay, so just a moment, let me move this to the top. And so I can get my workbook. Okay. My lecture notes. Okay, good. Let's continue. So we've just finished with this simple amortization, which is the one we've just done here. All right. Now, so we have inbuilt function in SL that you can use. Of course, you can try these ones. Someone mentioned is the PMT and all that in SL, whatever. Those simpler ones. That's good. But then, Of course, I love to do some of these things manual. It helps. You can add your own flexibilities to you, but then you can consider using this inbuilt Excel function. Now, if you want to calculate the interest payment using this inbuilt Excel function, this is the function you need to invoke, IPMT. Then it will ask for this information. And these are the explanations. But you see, this method will help you to, if you have a bullet debt and all that, it can handle it. So of course, you can take some time to look at the use of the Excel functions. Can you please share your worksheet? Yeah, I'm going to share that with you. I'll share that with you. They'll share that with you actually. I believe they have your emails, so they'll share that with you. Now, we are getting in there into the bit of complication. Well, there's nothing really difficult about how we're doing, but then step by step, we are getting into the things. Let's talk about interest rate. Before then, I think let's take a 5 minutes break. It's now 4 minutes break rather, 2:46 GMT. Let's get back at 2:50 GMT. And then we deal with interest rates. This is a very important side. We're going to handle the GRL, the SOFR rate and all that. We handle all that. So let's get back in 4 minutes time, 2:50. All right, welcome back. And from the break, just a short break. So quickly, let's get into it. Interest rates and implications for debt modeling. Interest rates and implications for debt modeling. Confirm if you can see my screen. Just want to be confident that you can see my screen. Just put something in the chat to confirm that you can see my screen. Okay. Great. So let's look at common interest rate structures. So mostly the interest rate structures, in fact, generally, is fixed rate or fixed interest rate structure, variable interest rate structure. In fact, there could be multiple debts taken by a company where some may be fixed rate, some may be variable rate, right? Now, so we have some pros and cons of each method. Like for the fixed rate, the pros are that it allows for precise cash flow forecasting as payment remain consistent. So you know how much you need to make up for interest or principal at any point in time. And it shields the borrowers from interest rate fluctuations, of course. Like what we've seen over the COVID period where interest rates kept changing and all that, and they are suffering a lot. It simplified the financial planning by eliminating uncertainty in interest expense. That's really good. The consequences side of it, it may have a higher interest rate compared to variable rates, especially during low rate environment when interest rate is generally low. And I'm going to explain what we mean by interest rate is low, interest rate is high. Then borrower may also miss out on potential savings if market rates decline. That's one thing. Now, generally, when we say rates on the market rate, the most obvious rate we deal with is the treasury bills and rates and all, or use on government securities. That, or maybe policy rates and all those things. Those are rates that actually give us some indication of whether interest rate is rising or falling, right? And most of the times, the variable interest rate loans are based on those high rates, and those rates are called the benchmark rates. So the variable interest rate structure, we're going to solve a question on this very soon. So typically, it offers some kind of lower interest rate compared to the fees during low rate periods. But then when rates are rising, then you have a problem. So your interest rate keep changing. Of course, if you've taken credit or personal loan in the country, you know that most of the loans the banks give are variable rate loans. You always see that DRR plus something %, right? So whatsoever DRR's rate is at any point in time, then you just add that thing to it, and then you get your interest rate. You are going to get into that. So now here we are. So now, so the variable rate is made up of the benchmark rate and a spread. A benchmark rate and a spread. An example of a quotation is SOFR plus 2%, and the SOFR is what we call the benchmark rate. And in fact, generally, we call it SOFR. A SOFR is a secured overnight financing rate. It's rate used in the United States. We are going to look at it. Then plus this 2% is known as the spread. Now, the benchmark rates, it forms the base interest rate component. It's a base interest rate. And then depending on your credibility, we add a margin. The higher the margin, the higher the risk of default. So if the bank expects or anticipates that you are likely to default, or the credit risk they are taking on is higher relative to maybe another, you are likely to pay more. And that is where we're adding that additional 2% or whatever to compensate for that. Now, so the benchmark rate actually reflects the broader economic factors such as central bank policies, inflation expectations, economic growth, and all that. They are reflected in the benchmark rate. That's it. And there are several types of benchmark rate if you look at some. Now, so a link to market benchmarks, like we have the SOFR, the secured overnight refinancing rates, which I mentioned. Then we have the The LIBOR is the landing interbank offer rate. Of course, it's being faded out of the system and replaced by the SOFR. In fact, the SOFR is a secured funding because it's secured by treasury bills or treasury instruments. And for the LIBOR was an unsecured borrowing. In fact, LIBOR wasn't actually tracking actual borrowing. It's just a matter of the rate at which those banks, the AA banks, believe they could borrow, not necessarily the rate at which they will borrow. In fact, they believe they could borrow, not necessarily the rate at which they have borrowed. So LIBOR actually is not reflecting actual transactions. LIBOR is just reflecting transactions they believe they could enter in at that particular rate. So it's more of an S-ante rather than a post-ante rate. Now for the LIBOR, the DRL is a Ghana reference rate. You look at some of these things soon. And the other benchmark rates, we can also have the government bond yields or the bills and all that. And also response to geopolitical events is something which gets responded, being part of the benchmark rate. The benchmark rate will reflect all those geopolitical risks and all that usually. The spread, which is the credit spread, is the additional interest rates premium, reflecting the borrower's credit risk, right? The higher the credit risk, I told you the spread is likely to be higher. Now, so changes based on the borrower's credit worthiness and financial health. Now, so market sentiment and investor confidence influence the perception of credit risks, and impacts from industry-specific conditions and regulatory changes also affects the borrower. Now, so the idea is that for the spread, it could persist over time. In fact, you're going to see it soon that the spread could persist over or throughout the life of the loan, but the benchmark rates may keep changing, right? I just put some few things here. The GRL benchmark mostly used in Ghana now, and the frequency of reset is reset periodically, often, did I say quarterly? I made a mistake. It's supposed to be monthly. So please get it. It's supposed to be monthly. Monthly basis, you have this one checked. Treasury bill, of course, government auctions treasury bills in the market regularly every week or whatever. And then so the rates are always there, right? So interbank rates, of course, these rates used by the banks for short-term lending and liquidity management, right? They can also be used for benchmarking. And these rates are set daily, right? Based on market transactions and liquidity conditions. And the SOFR, which is the secured overnight financing rate in the United States, is actually published daily by the Federal Reserve Bank of New York, reflecting overnight borrowing costs in US dollars. Now, most foreign denominated debt, like a dollar debt, even if taken in Ghana here or any country, you'll see the SOFR being used to determine the interest rate. You have SOFR plus something, right? I've seen a lot of that in the market. Hi, Julius, here 1 month, 3 months, and 6 months SOFR. Please, can you explain that? I hear 1 month, 3 months, and 6 months SOFR. Can you explain that? Yes, so I'll come to that soon. Any other question? In case where the loan is disbursed in bits, that's the most efficient way to prepare the amortization schedule, please. Or what's the most efficient? Oh, okay. So you can prepare amortization schedule per each loan. You can do it as per each loan. But then it all depends. Sometimes you can, those additional loans they keep disbursing, you can be adding it to the additions. That can also be done. But then if the new loans over the project's life have different features in terms of the term and all that, it may be necessary for you to re-prepare a different amortization for the loan. Now, so if we have the SOFR being, let me start with this. So you grab, if we have 1 month SOFR, 3 months SOFR, then 6 months SOFR, it's just basically the rate at which it's just the rate, it's just the money market rate for borrowing over a 6 month period. For example, when we're having a LIBOR, it tells you the rate at which those banks that were sampled to determine the LIBOR could borrow for, let's say, 6 months. Plus, AA rated banks can actually borrow over a 6-month period, that's a 6-month LIBOR. Over a 3-month period, that's a 3-month LIBOR. Over a 1-month period, that's a 1-month LIBOR. So in Ghana here, for example, if you are taking a loan and you are making interest payments monthly, and the interest payment is structured in a variable interest rate structure, and you are having something like SOFR plus 2%, and every month we need to determine the SOFR that applies for the next month's borrowing, for the next month interest payment. Then at the end of that month, we determine or we agree on the SOFR. Of course, these are published, so you can get a SOFR that applies for the next one too. So it tells you the minimum or the base interest rate at which borrowings are made over a 1-month period. That's a 1-month LIBOR. So if interest rate is going to, or interest payment is going to be structured by the bank on a monthly basis, then 1 month SOFR makes sense. If interest payment is going to be on a quarterly basis, then 3 months SOFR is the best. If interest payment will be on a semi-annual basis, then 6 months SOFR is a best benchmark rate. All right. Good. Thank you very much. Now, foreign currency debt and implications. Now, so as I mentioned, even in Ghana here, when they are structuring interest rates for interest rate structures for dollar loan in Ghana is now SOFR plus something, right? In any country, I believe, will be the SOFR plus something. Usually, is the most used benchmark now for the loan pricing in the United States, right? Now, so foreign currency debt actually raises several concerns across cash flow planning and companies' financial statement. The reason is this. With what we just did earlier, where we amortized the 168,000, that 168,000 is a CD debt. If it were a dollar debt, then it raises concerns. The reason why it's going to raise concern is that the financial statement of the company is prepared in Ghana cedis. So if now you have the debt in USD and the debt is amortized in USD and then translated into Ghana cedi, then there will be forex losses. There will be losses. I mentioned losses because the cedi usually depreciates against the dollar. So in the long run, or when everything is summed up, you realize that there will be some losses over time, right? Now, that is very, very important for us to look at, because you are not just making interest payment, you are also revaluing the debt at the end of every year onto your balance sheet. So when the debt is revalued, and then this revaluation thing is happening as per exchange rate, because if the exchange rate was 15 or 14 cedis last year, and it has increased to 15 cedis this year, even if the principal hasn't changed, the value of the debt hasn't changed, even if no interest was charged on the debt and no principal was repaid, the value of the debt on the balance sheet will increase only because of the depreciation of the cedi. So changes in the exchange rate lead to gains and losses on the debt revaluation, and these are recognized in the income statement, impacting what? The net income or net profit. Now, so when we talk about the balance sheet too, the debt's carrying value will have to be adjusted with the exchange rate fluctuations. So when exchange rate changes, then we need to revalue the debt at the end of the year. So that will bring about all those exchange rate losses, gains and losses, and that's how we pass then onto the income statement. So the new value of the debt in cedi term is restated on the balance sheet, and the difference, or in other words, the revaluation or the gains and losses arising from the revaluation, the currency revaluation, will get onto the income statement as a gain or loss. There's a question. Let me address that quickly. In forecasting, what exchange rate do you use for set conversions? Okay, so for set conversion, I prefer to use from Fitch. So Fitch has a publication on some of these things. So I prefer to use from Fitch forecast of exchange rate. It may not be the best made, but let me tell you, when you do works like this, you can hide behind Fitch and say that, well, that is the answer. Fitch will have to interpret, because they are claiming that based on their calculations, That should be the exchange rate. You can't go and take somebody's trouble and carry it as yours. They have to explain themselves. All right, Daniel, that's true, right? All right. The best way of like taking or exempting yourself from liability is to quote a credible source and let everybody know that they are the ones that claim. So the burden of proof is on them. Okay. Right. So I'll provide some of those information. That's what I'm looking for in terms of for the work we are going to be doing. So now, and again, because of the exposure to the foreign currency, you also have interest or cash flow planning implications. Okay, increases cash flow risk. Even if it is at a fixed rate, even if the debt is at a fixed rate, but because you're exposed to a foreign currency and that or a currency that's different from your reporting currency, you'll be exposed to cash flow risk. So that advantage associated with fixed rate loan, you won't get it again. Because you see, you have a fixed rate loan. If it is in Ghana city, yes, you have a predictable cash flows. But now we are dealing with a foreign denominated debt. So you don't enjoy that again. Even if the interest is fixed, but for the fact that exchange rates may be volatile, you are not going to be enjoying that benefit in that sense again. Yeah, I hope that brings home the point. Good. Now let's continue. Let's look at this question. Now, so we're going to solve this together. So Aqua Oil and Gas Exploration Limited. So Aqua Oil and Gas Exploration Limited, an upstream oil and gas company, has been operating in Ghana for the past 10 years. The company has successfully acquired rights to explore crude oil within the country, and its financial statements are prepared in Ghana cedis. The parent company of Aqua Oil and Gas Exploration Limited is listed on the Johannesburg Stock Exchange. Over the past decade, Aqua Oil and Gas Exploration has demonstrated strong financial performance with consistent revenue growth and profitability. The company's balance sheet reflects a healthy mix of equity and manageable levels of debt, positioning it well for future expansion. The company is now in the process of acquiring exploration rights in Nigeria for petroleum exploration. To finance the new project, the directors have decided on a funding split of 70% debt and 30% equity. Hope you're following so far. They have engaged the services of a transaction advisor to secure the necessary debt financing. So that I don't miss anything. I think somebody put something here. Isn't it? What if you don't have access? Oh, then that's a different problem. It appears in some cases there is a limit on amount to be allowed as deductible exchange losses for tax purpose, correct? Oh, yes, I'm not a tax expert, so I think that one can be, seek that point from a tax people. I think that when tax consultant are computer CIT, but for reporting, I think it's all deductible. Okay. Yeah, so Daniel, I've answered that question. Thank you very much, Daniel. Okay, so the transaction advisor has provided an update indicating that a syndicate of banks is willing to contribute towards the debt capital requirement. You see, they want to do some project in Nigeria. They need money, right? So they get an advisor who is consulting a syndicate. The financing package consists of 3 tranches with the following terms. Number 1, tranche 1, 50 million at an interest rate of SOFR plus 2% with a tenor of 3 years. Tranche 2, 250 million at an interest rate of GRR plus 1.3% with a tenor of 5 years. So you can see that the dollar loan is at the SOFR plus 2%. And the CD loan is that of GRR plus 1.3%. Tranche 3, 150 million at a fixed interest rate of 27% with a tenor of 5 years. The loan term stipulates that interest and principal payments are to be made on a monthly basis. So you have to prepare a debt schedule and show how the above transaction affects the financial statement of the company over the life of the debt. Good. Now, I'm not going to do everything here, but well, I'm not going to do everything here. The reason is that for the third one, I dealt with it. I dealt with a similar question That's the last amortization work we did. The first and the second are related, but then the first is more advanced because it deals with, apart from it being a floating rate, whatever, it deals with a foreign currency matter again. So because of that, I'm going to handle just the tranche 1. So you can handle the rest. Let's get back to our Excel. Let me stop sharing and get my Excel. Wait, no, something. Okay, so I get my Excel now. So let me now share my screen. Now, so this is amortization. This was amortization. Now, so the second one, I want to just duplicate this sheet and call it. So I want to give it another name. In fact, let me call it foreign debt. Foreign debt, okay. So, and the foreign debt, we have SOFR plus 2% for 3 years, 50 million. 50 million for 3 years. SOFR plus 2%, 50 million for 3 years. Okay. Okay, so I don't know why. Let me stop sharing again and reshare. Okay, 50 million for 3 years. So let's look at that. Now, so I'll just change some few things here, right, guys? I will first let me take off this color and then, okay. So the principal here is 50 million. Make it 50,000, right? And the acquisition of the loan, let's just use the same period, okay, just for demonstration purpose. And interest rates here will be SOFR plus 2%, so we know. And then we also have the tenor of the loan is 3 years, so 3 times 12, that's going to give us 36 months. There's no principal and interest moratorium. And you see the way this jumped. Immediately, I took the principal and interest moratorium. This principal repayment jumped. It jumped automatically. It's gone again. If I make it 12 months, so I can run a lot of things. You see how it's changing. And that's why SL, if you know how to build in some conditional statement in SL, it helps you a lot. And for the day count, let's do 30 by 360. 30 by actual. Let's do 30 by actual. And then what else? I need to put in the currency. I forgot the first one. Supposed to have put the currency. So the currency is a key thing to put. The currency here is USD. The currency here is USD. Okay, so I think I have my basic facts there. There's some questions in the test box. That's correct. Your debt to equity ratio shouldn't exceed 3:1. Any exchange losses and interest expense incurred in excess is not deductible for tax purposes. Oh, I think the discussion on the tax is still ongoing. Thank you very much, guys, for that response to his questions. Yeah. All right, so we have something here, and we want to do actual by, or 30 by actual, right? Because I'm doing 30 by actual, I can continue to use these actual number of days in a month again. I now have to use just 30. So I'm going to run this to 30. And number 2, I want this to be for only 3 years. I can write a conditional statement to delete the rest, but it will take a lot of time. So let me just do this to delete the rest from the sheet. So I can have my sheet up to 36 months alone. And now I have my days, day count, 30 days in a month, then 365. Sorry, then the interest rate here, we have the SOFR plus 2%. Now, the question is, what is the SOFR? And that's what we need to ask ourselves now. Now, guys, let me say this thing to you. This is where complications in debt modeling starts. It starts here because if I know the SOFR today, then what is the SOFR for next month, for next 2 months, for next 3 months, for next 4 months? Meanwhile, I've forgotten that SOFR actually is published just at the end of the month. I can only know it in the future. So what can be done is that you can do some scenario analysis and have some range of SOFR. Okay, you can do scenario analysis to know some range of SOFR. So I'm going to show you how to do one. So let's get a SOFR here. And we know that for the spread persists throughout the term of the loan. So the spread is there, 2%. And all we want to do is to add the benchmark and the spread. We want to do that. The benchmark and the spread. That's what we want to do. Now, every other thing is fine, right? So you can see they are all changing accordingly. Now, the question is, what benchmark rate do we use? Now, when I get onto the markets, I collected some data yesterday for some official work. And as at the end of June, the SOFR rate was 5.33. 5.33 for June. Now, I try to get the maximum and the minimum SOFR over some period. I think since 2018, the maximum and the minimum SOFR, in fact, the minimum SOFR over that period was 0.01, and the maximum SOFR was about 5.34. That's the maximum. So I can try the maximum, the minimum, and the mean to see whether my cash flows are still looking good. So let me just try that for you to see. So let me calculate that here. And I'm coming in. I have another machine from which I'm taking some data from. So just a moment. Maximum SOFR. Okay, so I have my maximum SOFR and all that, minimum and all that. So one thing also I want to do is that I want to create some, do some data validation, right? A few data validations. Maybe let me just do it here. So I'll have my SOFR. And then, so far I want to have some 3 values here. I want to have 1%. I want to have 5 points, maybe the mean of or the average of the average or whatever. So just a moment. Let me get some real-time data for you. So I get an average, 1.98. The average over the period is 1.98, 1.98%. And the highest is 5.34. And clearly, it's due to these COVID issues, right? So I have that here. Okay, so I come back to my debt point here. Then I go to data, and I go to data validation. Let me move this from here. I go to data validation. I want to create a list. And the source, I want to pick it from here. Oh, I should have moved this. The source of that, I'm picking it from here, this particular worksheet. Enter, and move this back again. This one problem with this thing. So I have my data validation created this way. So I can actually do some kind of analysis like sensitivity analysis or those kind of stuff, right? Let me just polish this bit. Okay, good. So I can go back here again. Working with this cell sometimes could be troublesome. Okay, good. So I can do my data validation. I have that my drop down button. So if I want to do, so currently it's at 1 point something percent here. Let's do that. Now, so let's say the benchmark rate is currently this. Whatsoever value it is here, I want to log it. I want to log it. So I do some sensitivity analysis to know how worse things can go. So I log that. Then I drag it. Hot of currency converter. I don't want to do it that way. I'll show you why. I'll show you why. Okay. For the purpose of the modeling financial statement, I'll show you why. So this is what we have. So based on this is what we have. But then I want to also do something here quickly for you to see. And what I want to do is this. I want to, let me check this. Okay. Okay. So I want to do some summary here. And that's why this particular work, I want to take my time to do it. Opening balance here. Then I do some additions. If there are additions to the debt. Oh, what's happening? Delete. So if there are additions to the debt, let me change all this to Arial first. I don't know why this freezing like this. Arial. Okay. So I do some additions. If I'm adding a debt to it, then of course that gives me amortizable principal. Amortizable principal. Then from there, I do interest accrued. And with the interest accrued, and then I'll do interest paid. Then principal repaid. Then I'll have, so let me shift this a bit down so I can have some space. Principal repaid, then I have closing balance. Then from the closing balance, I can have my forex loss on translation of the debt, right? Now, so year one, then year two, then year three. This is a 3-year bond, a 3-year debt, right? Now, so from here, I don't know why I'm going to write this in this particular room. That it can be crazy. So this is a summary of the amortization schedule I'm creating. Now, so the opening balance, there was nothing there. And then a debt was added. How much? 50,000. And these are in dollars, right? USD thousands. Okay. So 50,000. Okay. Now, the amortizable principal is then the sum of this and this. I don't know why my Excel is failing me today, trying to embarrass me. So we sum up this and we can bold it. Then we can do some line drawing, just basically to put something at the top here. Then basically, right. Now, what is accrued interest for 2021? So since this is a simple debt, I don't have to complicate anything. I'll come straight to accrued interest for 2021. And I have not done the years here. I'm sorry. Why is it 2021 for year one? Then we have year two. But for the year one first, I can count just up to 12. Okay, and maybe a merge and center, put this here, put this maybe here. Yeah, merge here. So I can drag this so that it populates for the rest. Okay. Then also, so that I can track my things properly, I want to do this. So I pull this in a box nicely. I just want to be able to track my things properly, guys. Then I do the same here as well. I do the same here. I pull them in boxes nicely. And finally, I do this. I put it in boxes nicely. And you see why I want to do this. I don't want to make any mistake when I'm summing up the interest accrued. So when I come here, interest accrued, I'll just sum up for the first 12 months. I'm done. Then for the interest paid, to the same thing. But, well, for interest paid, just for the purpose of learning, there's faster ways I can do this, but then I want everybody to follow. So we do that. Principal repaid, we do the same. We sum up. Principal repaid. You put that there. We done. So at the end of the first year, I want to see how much is left to be paid on the debt. And let me do some few house cleaning jobs. So how much will be left will be this. Forgotten that I'm working with Apple. So, all right, this is how much will be left. And we are going to confirm if that is really true, that this is the amount that is left at the end of the first year. So let's check. Yes, that is how much is left at the end of the first year. We have it here, 33,000. Come back here. And then the amount left at the end of the first year is moved to the second year. Then in that order. Then the amortization works in that order. We drag this also. Then we are moving forward. Additions, no additions in subsequent period. And then interest accrued. Okay. Let's look at that. Interest accrued here. We have from here to here. Then the interest actually paid, we also move from here to here. You see, we are done with amortization. We're just summarizing our result nicely, right? Then principal repaid, we do the same from here to here. We are left with one more step. So we are left with 16,666,67. Let's check whether that is true. 16,666,67. Great, we are winning. Formulas are working. Let's see. Somebody put something here. Hope you are using a new sheet for the second example. Yeah, I'm using a new sheet. Please, will this Excel sheet be shared with us after? Yes, it will be shared with you. It will be shared with you. Great. All right. So the final side, sum up. We have the final or the last interest accrued here. We pick it. This is just a 3-year loan. Nice and simple. Then when we come to the interest paid, we pick the last one as well, the total interest paid, last one. Then when we come to the principal repaid, then we do the same. We come to the last one. Oops, and you see that this place is 0. It means that nothing is left in 3 years' time, right? So what do? We have this place also being 0. We've done a good job, right? We've done a good job. All right, good job done. So this 0, this is a fully amortized. So we fully amortize the debt. We are done. But we are not done because this is in dollars. We need to get this onto the financial statement. But financial statement is in Ghana cedi. So what then do we do? And to resolve this problem, I have some rates I want to apply. I want to transfer here which I obtained from Fitch for some work I was doing. And I was doing a similar thing, right? At work. So I want to show you, I want to give those rates so that we use that as basis. But before we can do that, I'll need to name the years so that you know exactly the years we are using. Because for the purpose of the rates, this should be 2025, this should be 2026, and this to be 2027. And so I can also come here and name it 2025, 2020. I don't know why I've done this. I'm not able to just drag it. 2027. Okay, good. So we have that done. Now I can write something here. So let me say forest. Let me write it at the top here. Forest. So Ghana cedi to USD, 12 cedis, 78 pesos. Oh, sorry, 13 cedis, 78 pesos. I know you won't agree, but then this from Fitch. Fitch is saying that things will get down. Like the economy will come down. It's giving us hope. So if you say you won't agree, I know some of you will not agree. 14 points. 94. Am I doing the thing? Oh no, 14.94, 13 points. It's 2025. What am I doing? I made a mistake actually here. In fact, from 2025, Fitch is saying 12.78. I'm stressing on it. This one is from Fitch. Fitch is saying, not me. Okay. Why don't we use the year function? Well, yeah, we can do that. So that when we change the date, it will change automatically. Yeah, we can do. For here, I'm just showing something. But when I'm working out these things in practice, there are more I could do. But those ones are just to make the things look nice. Okay, so now we've just handled the issue of, debt amortization. So I want us to now quickly look at the situation in the context of, or maybe if we want to get the losses or gains through forest movement, right? Now, so if we take 2025 like this is at the end of the year, we can get the value of the debt in Ghana, in Ghana cedi term, right? All right. Now, so we will not record any loss this year. But then I know people will say, well, I've taken a loan at the beginning of the year. By the end of the year, I can see the impact on the currency, whatever. But then when we talk about translation, 2025, we can use average rate. This 12.78 is an average rate in 2025. So of course, you can translate everything at this rate of 12.78, including the closing balance. Here in 2026, everything will be translated at the rates, at the average rate for the year 2026, including the closing balance. Right. So this is what I can do, and which I want to show you. Now, what I can do is this. I can just take, let me show you this too. Wait. Okay, so these minus this, that gives me the forest movement. Okay, and then I'll multiply by this. So this is giving it to me in Ghana cedis. This forest loss is in Ghana cedis. So I'm translating the opening balance. The assumption here is that, you see, the assumption here is that all these rates here are going to be in Ghana. All these are going to be translated on 20 or at 2026 exchange rate, and this one at 2025 exchange rate, and this one at 2027 exchange rate. So since all are going to be translated at 2026 exchange rate, means the opening balance will be done. So, and here all of them. So the only difference will be the exchange opening balances. In fact, if I re-prepare this amortization, if I translate everything here into another table, but based in Ghana cedis, you see that the difference will be that. All right, so that is it. So this goes into the P&L. So this goes into P&L as the forex loss. I'll send that to P&L. All right, so the closing balance will be retranslated into Ghana cedi, of course. If you translate this, translate that, you translate this at 12.78, translate this as so and so rate, and it goes to the balance sheet at the end of the year. The interest accrued and interest payment, principal repayment, all will be translated at the respective rate in which the transaction was effected, right? So that's how it's done. Good. Good. A very tough day. The day is quite busy. In fact, it's supposed to be closing now, but guys, you know you have to stick with me to get the rest done. If you want to stick with me, you can stick with me, because these are recorded on, it's less than some, I have some few slides here just to complete it. And you can get this lecture on YouTube as well. So in case you want to stick with me, you can stick here. And if you have a question, you ask. Otherwise, if you are very busy, you can still watch it on YouTube. Just that you may not have those questions responded to in real time. All right. Now, enough of debt modeling. Let's get into repayment planning and implications for debt modeling. So this is also an interesting area. So repayment planning. First one, so general considerations in repayment planning. Now, so cash flow management is a key thing. So ensure sufficient cash flow to meet debt obligation on time, budgeting for regular principal and interest payments to avoid liquidity constraints. That's a general one that everybody knows. Now, so you know that, especially if you are granted variable rate loans, then interest rate tend to change or tend to move as the economy changes. So like the COVID period and the post-Russia and Ukraine war and all that created so much problems for the whole world. Interest rate has really increased significantly, right? So it will affect your payment plan. It will affect your cash flows, right? Another one here, very, very important, and I want you to get this at the back of your mind because we're going to be using it, the debt service coverage ratio. So maintain a healthy debt service coverage ratio to demonstrate ability to service debt obligations comfortably. So calculate the debt service coverage ratio, or the DSCR. Get this on your mind, the DSCR, regularly to assess financial health and borrowing capability or capacity. Then the last thing is review your debt structure to match repayment schedules with cash flow generation. And manage maturity profile to avoid excessive refinancing risk and ensure sustainability. Now, let's get into it further. Now, so key ratios in evaluating ability to pay. We have the debt to equity ratio, the debt to asset ratio. Then there are general ones you have been hearing. Then we have the debt service coverage ratio. Now, the debt service coverage ratio will be defined in the facility letter or the term sheet. On the term sheet, they will define what constitutes a debt service coverage ratio. If I say what constitutes, I mean the formula we know must be something divided by something. But what is that something? At the top, the cash flow at the top, divided by the debt service. And the question to you is that what is debt service? Because the cash flow at the top could be defined as EBITDA, or it could be defined as operating cash flow, or it could be defined as free cash flow. Like there may be different definitions. Because supposing the company has an existing debt and is going for another debt, then, and we know that the existing debt has priority over the company in terms of payment. or it's more of a senior debt, and a new debt is a subordinated debt, when the lender is drafting the term sheet, the lender will define what constitutes a cash flow. It may be the operating cash flow less interest and principal payment for the existing debt. So the term sheet will define what constitutes a debt service coverage ratio. These are no jokes. Interest coverage ratio, the same thing. Then we have the generic ones like current ratio. Now, let's get into some things. So I picked some two things from the world of project management to show you something. Now, so in project finance here, lenders only have recourse to the cash flows from the project, not outside the cash flows of the project. You see, projects are structured like a special purpose vehicle. Now, if a company is doing a project and has set it up legally as a special purpose vehicle, if the company fails to pay the debt that it took for the project, the lender cannot run to the company for the company to pay. No. The project debt are specifically going to be met from the project cash flows, not outside the project cash flows. Therefore, there must be sufficient cash flow to pay the debt, okay, you raise to finance the project. Very, very important. There must be sufficient cash flows. So a project that is not able to generate that has problem. We can meet the interest and principal repayments outside the project cash flows. Right? Now, so the only protection is at the level of the project. And therefore, the risk of project cash flows not sufficient to meet debt service must be closely managed. And what do we mean by debt service? When we say debt service, we are talking about both principal and interest payment. That's what we mean by debt service, at least for now. In some definitions, like say the term sheet or the facility letter, there may be other nuances to it. A debt service may be interest only, maybe over a period, and may change into interest and principal, depending. Right. Now, so the DSRA, I'll be coming to it soon, what it means. So I just want you to follow me. Now, so suppose a project with the following cash flow streams over its life. Now, so, and also the agreement with the lender is such that the DSCR should not fall below 1.02. Now, so DSCR, I'll show you soon what we really mean by that. Now, what I've written here, let me just, I think I should edit the notes on something. It's supposed to be, I mentioned the cards. I should have explained what the card is. So cash available for debt payments, or for debt service, sorry, for debt service. Some people call it cash flow available. So you see CFA or CFAT. I think let me use the CFAT instead. A lot of people use CFAT. So it will be cash flow available for debt payments. I'll share my screen so you see what I have here. Okay, so this is what we have now. I hope you can see. Now, so this cash flow available for debt service, that's CFATs. Now, look at how we have the revenue. So this is a project, a 3-year project. You expect revenue of 30 in year 1, 25 in year 2, and 30 in year 3. I want you to see something here. Now, if you look at the operating costs, when we take out operating costs, we have the cash flow available for debt services, 18, 13, 18. It looks like a good cash flow, right? But then we have something in the term sheets that the DSCR should not fall below 1.02. Now, so let's calculate the DSCR and see. So the DSCR is the CFA. I have to edit this before I share the notes with you. That's the cash flow available for debt service, which is like the revenue minus operating cost, divided by debt service. Or think about it like operating cash flow divided by debt service. And debt service is the principal plus the interest repayment. Okay, the principal repayment plus the interest payment. The two sums together to get the debt service. How much you are giving to service the debt. And so we require 15, 15, 15 throughout. Now look at something. You see that for year one, you made a cash flows of 18. So giving us 15 to pay that is okay. Giving us that 18 to pay for 15 is okay. The 18 can cover the 15. So we have a DSCR of 1.2. In year two, we have a DSCR of 0.87. It tells you that the cash flows are not sufficient to cover. You get a point. Now, you may say that, oh, well, overall, the company will be generating 49 and covering a debt service of 45. So you think that, oh, well, they said the minimum, the DSCR should be 1.02. Since we are doing 1.09, we are good to go. But that's not correct. You have defaulted. You see, you have defaulted, and that creates problem for the creditor. You have defaulted in year two because year two gave you cash flow of 13, but you have a commitment of 15. So your DSCR was 0.87. So you've defaulted. Now, year three, you've not defaulted. But this is a credit event. The DSCR got breached, therefore you defaulted. Now, so in cases like that, what should borrowers do, or lenders do? Should they wait until people default? So because they know that the project may delay, circumstances may make the project not like this infrastructure project, let's say the construction of the motorway and all that, and they did the financial projections, they believe this is how things should be, that suddenly things don't tend to be like that. Then there's a problem. Now, what should they do? So the lender could require the borrower to put some cash aside in case the project cash flows are not sufficient to cover the debt service. Can you put some cash aside in a certain account somewhere? And we will ask you to set that account up at a point in the life of the project or the construction period. And that account is what we call the debt service reserve account. You see, the debt service reserve account, for example, if in a construction period, if let's say 2 years of construction, they may require you to set up the account maybe in the last stage of the construction. Then the account must be initially funded. And now this is the complication when it comes to the debt service account. You are required to fund the account from day one, or meaning put some money into the account from day one. Where are you going to get the money from? Usually, if they are doing project, they are going to be doing around 70% debt, 30% equity. So projects are highly leveraged, right? 70% debt, 30% equity. So the debt service account is likely to be financed by debt and equity. So the same money you are borrowing, you are going to keep part in that account. You put some in that account. Then the question now is, how much do they place in the account? Now, usually, for the debt service account, you must put like between 3 to 12 months of debt service. So once the project starts, once you start generating revenue, like once the debt service period starts, for the next 3 to 12 months, debt service requirement, meaning the principals and the interest, must be placed in that account up to the next 12 months. Now, the higher the rates, the higher the likelihood that the bank will request for more. But then they could request 3 months for less risky projects. And there are benefits to that. The reason is that in case in a particular month, you fail to make payment because cash flows on the project are not good, the bank can actually lay hold on the debt service account. And so that it doesn't run the risk of default. Number two, in case you want to restructure the debt, at least there'll be some money in there to be settling interest rate or interest and principal payment while we think about settling or restructuring the debt. Now, so there should be some target balance there, and that target balance, as I say, will be around 3 to 12 months of debt service. And difficulties arise. The difficulty is that you need to keep funding that account. And also, that account is being funded by debt and equity. And since it's being funded by debt, it's increasing your debt, future debt payment. And now, the higher the future debt payment, the higher the withdrawal from the debt service account, and the need for funding we are still going to be funding from debt. So it creates kind of like circularities in the debt service account. In fact, for the purpose of what we're doing, debt service account is not what we want to be covering. In fact, the details of that. But this takes a point home, because even in corporate finance engagement now, you see the market demanding for it, especially when you want to issue fixed income securities. Okay. Now, the next one is I'm coming on. Is a debt service coverage ratio. Good. So I want to show you something. When it comes to repayment schedules, especially in project, the most commonly used debt repayment model in project finance since that is the debt service coverage ratio. Debt service coverage ratio is the most popular. Now, the whole thing is this: because the debt must be paid out of the cash flows of the project, we can be ignorant of the cash flows of the project. While we can be ignorant of the cash flows from a corporate finance transaction point of view to some extent, because we know that, of course, even if the cash flow from so and so asset they want to buy cannot service the debt, the company itself can fetch money from the account of the operations to settle. But when it comes to project finance, the settlement of the debt is purely from the project cash flows. Because of that, we can be ignorant about the project cash flow. Instead of the lender coming out with a term sheet and say, well, this is the repayment schedule, the lender will rather align the repayment schedule as per the cash flows from the project. Let's suppose a construction project which was financed by a 4-year debt from a syndication. So some syndicate of banks, right? They agree to give a 4-year debt. Okay. Now the DSCR sculpting is going to work like this. That's what we call a DSCR sculpting. It's going to work like this. Now, suppose that the cash available for debt service within the debt tenor of the 4 years are listed below. These are the cash available. And here we know the debt reserve, service reserve account. We know how to get the cash flow available for debt service here. Now we have that. So here I'm not going to really go into the details of providing you how we calculated it. So I've just provided with the cash flows over the 4-year period. Now when we add all of them together, it gives us a total cash flow as we see it here. Now the debt service, just a moment. So the debt service is, how do we then calculate the debt service? Because in the previous formula I told you what the DSCR is. The DSCR is calculated by taking the cash available for debt service and dividing it by debt service, right? Now, so we can make debt service the subject. If we make debt service the subject, then it takes us here. If we make debt service the subject, then debt service is equal to the cash available for debt service divided by the debt service coverage ratio. Okay, why are we doing this? Now, in the terms or on the term sheet, they define what the debt service coverage ratio is. You shouldn't fall below. Your repayment shouldn't fall below the debt service coverage ratio. It can be 1.3. In fact, the popular one on the market is 1.25, 1.3. Popular on the market. Now, so your debt service coverage ratio shouldn't fall below, let's say, 1.3 as a starting point. It shouldn't fall below 1.3. And that is what I have here. The debt service coverage ratio target is 1.3. That's what we are working with. So you need to work with this. So how we structure repayment for project finance is different from what we just did in Excel. That one is usually for corporate finance, but the most popular one is debt or is a DSCR sculpting. And follow me as I show you how this is done for you to get an idea. Now, we know the target DSCR we want to achieve. We know the cash flow available for debt service. Now, with the target DSCR and the cash flow available for debt service, we are able to calculate the debt service. How much, or we are able to calculate the debt service as we have here. This is the amount available to pay interest and principal on annual basis. 269, 211, 33077, and 143. These are the amounts available to service debt. No, what am I talking about? This is the amount allocated towards debt settlement. You get a point? Because we are trying to say that the whole amount here will be used to settle debt. So if this is the whole amount, then how much debt can this settle? In other words, that's what we're doing. How much debt can this settle? Now, in the first year, we need to first calculate the interest on the debt. Now, the debt they have taken is, I think I place it here, 766. This is the debt being taken, 766. Is that okay? A debt of 766 has been taken. So in the first year, the interest rate on the debt I place is 10%. So you do 10% of 766. And that gives us an interest of what? 76.6. So this 76.6 will be paid first. So the amount available to settle the debt is this. Based on the DSCR we are looking for, this is the amount we are putting together to settle. So we pay the interest first. That's 76.6. When we are done with interest payment, how much is left? 192.63 will be moved towards principal settlement because we are done with interest settlement. So this 192 will move to settle principal. Now, so this amount available for principal settlement. So we now pay principal. Don't forget, we have the 766 here. So when we pay principal, we pay 192 out of it. We are left with what? 573. We move to the second year. Now, the second year to the debt service is 211. And debt service, as we know, is the sum of principal and interest. So we take out that of the interest. And this is the amount available for principal. So we used to pay part of the principal again, 573. Then we are left with 419 to pay. We move to the third year. Interest is 4192. And you know how the interest is calculated. For the third year, for example, it's a matter of taking 10% and multiplying it by the opening balance of the debt, which is 419. And now I'm doing things in annual terms, but then you can do things on monthly basis. Okay. Okay. Now, so when you make this amount is available for debt payment, when you make the debt payment, this is the amount of debt you are left with. By year 4, you are done with the debt payment and you have extra 0.5 left. So now this is something that the project managers are going to create. They'll create the DSCR scouting and they'll discuss with the bank and agree with the bank. So the bank now have a repayment schedule. The repayment schedule is this. Yes, these are the interests that are going to be paid, and these are the principal repayment. So you could see that these are different from what we did earlier. The principal repayment are not consistent. 192 drop to 158, increase to 288, drop to 130. That's the nature of project. That's the nature of project. That is how it works. That's how project finance works. Okay. Any question? Then we move to the last section. The last 2 sessions, then we are done. Any question? No question. Good. Now let's move to debt restructuring and refinancing and implications for debt modeling. Now, what is debt refinancing? Today the class is keeping longer, and it's because of the things I'm covering, and you can see that financial modeling is actually a lot. You know, someone was asking me some time ago, hey, why 18 hours in total? I was like, if I wish I could even get more than that. But then just using it. So refinancing is actually a process of replacing existing debt obligation with new debt that usually comes with a more favorable terms, right? So let's say the company borrowed money and then the company wants to refinance the money. What it means is that maybe that one is coming due and they need to borrow from another place to repay the existing debt. And then they have a new creditor now to deal with. That's the refinancing. Now, we are going to see soon that that is different from restructuring. So implication for modeling. So in debt modeling, analyzing a debt refinancing option involves projecting the terms of the new debt, such as interest rate, repayment schedules, and any associated fees to evaluate the impact on future cash flows. Very important. And also, we can assess the impact of the debt refinancing on the company's financial statement. We can consider the costs associated with the refinancing, such as the transaction fee and early repayment penalties. So you see, the whole thing is that it may even be necessary for you to renegotiate the existing debt than going to take one to refinance this, right? But there are cases where maybe the creditor may not like to continue with you, maybe due to your history and all that. So it may be necessary to refinance. Now, debt restructuring. So when we talk about restructuring, actually refers to the process of modifying the terms and conditions of the existing debt to address financial challenges faced by a company. So the restructuring is with the same bank or the same creditor. And so you want to renegotiate the terms, maybe the interest rate. Sometimes interest rate should be waived. Sometimes part of the debt should be forgiven. And maybe you want to change the tenor of the load of the debt and all those things apart of the debt restructuring. Now, it has some implication for debt modeling because so understanding the implication of debt restructuring involves analyzing the impact of the proposed change on a company's financial statement and future cash flows. And also, debt restructuring may also affect interest expense and debt service obligation. In fact, since these are coming with new terms, the debt service coverage ratio calculations and the requirement in terms of the debt service reserve accounts and all that may also complicate things. So you have to incorporate these new terms and conditions of the restructured debt into your financial projections and evaluate the effect on profitability, liquidity, and debt coverage ratios. And also, the key aspect of the debt restructuring is determining the potential cost savings or increased costs associated with the restructuring. Now, this is a question on that. Then the last thing that I'd like to do with you is to get into or solve the last puzzle, which is what if we are doing the financial projections for valuation purpose, for business valuation purpose? If we do so for business valuation purpose, the approach we are going to be using is going to be different when we are doing the debt modeling. Not that approach, but the various metrics we'll be using will be different. Okay. A question here, please explain debt financing, refinancing in layman's terms. Or debt refinancing, you go and borrow from Peter to people. That's all. I think that's the simplest way I can explain it in the layman's terms. So, is it borrow from Peter to paper or steal from Peter to paper? So you go to another bank to borrow and you use to settle the previous one you have. So you have a new creditor. A lot of people do it. When they realize that interest rate is cheaper, yeah, they go and borrow at a cheaper rate used to pay down or pay off the old loan they've taken. That's debt refinancing. All right. There's a question here. Because of time, I'm just going to read and explain. The best thing would have been for me to solve it, right? Let's look at it. Debt restructuring. So Eastern Mines Limited. So you can solve it if you have challenges. When we meet, you show me that. And the things I'm showing here are very practical stuff. These are very, very practical matters. It shows you sometimes the complexities involved in practice. That when you take the theory, what you see in theory and what you see in practice, the theory is usually simpler. In most cases, it's simpler than a practice. Now, Eastern Mines Limited. So you are part of a team asked to advise a client, Eastern Mines Limited, on its debt restructuring program. Let's look at it. So Esteem Mines Limited in Ghana faces financial distress due to substantial debt, including bank loans contracted from GCB Bank a year ago for financing working capital and corporate bonds issued in the local fixed income market 4 years ago. Okay. Now, recent defaults in the coupon payment on the corporate bonds have exacerbated the situation. With the bonds principal nearing maturity in a year, the company's financial stability is under threat. Because when the bond principal nears maturity and it matures, they must pay, but they don't have money. So is there something they can do about that situation? So they look at it in the next 1 year, they do their financial projections and realize that they can't pay. Can they do something about it? Will they have to refinance it or restructure it? Let's see. As at the last financial statement date, December 30, 2022, I've not updated these dates, right? The following financial ratios were recorded. Debt service coverage ratio currently at 0.6. That's quite bad because usually we expect this to be around 1.2, 1.25, 1.3. Gearing is 70%. Interest coverage ratio is 0.8. Now, things are quite bad because it means that the cash flows cannot even pay. They can barely pay interest expense. Now, how are you going to be able to pay that huge chunk of principal when the bond matures? That's creating problems. So it's an emergency issue. Now, recent board actions. The board successfully negotiated with the bank for the refinancing of the loan with GCB with an additional, the board successfully negotiated with the bank for the refinancing of the loan with GCB with an original term of 2 years maturing in December 2024, extending the tenor to December 2025. So what it means is that the existing debt has a maturity original term of 2 years. And don't forget, it was a working capital debt or loan taken a year ago. So it means there's 1 year more to go, right? If I've read this correctly. Now, however, the primary focus is now on restructuring the corporate bonds to alleviate the imminent financial strain. Now, the outstanding bond details as at November 2023 are as follows. The face value of the bond is 20 million. Yield to maturity is 18%. Coupon rate is 10%. Time to maturity is 1 year, meaning level 1 year to maturity. I see. That's a bit of a problem, eh? 1 year left to maturity. Now, so that's why they are concerned. Because the face value of the bond, they need to pay this 20 million. They don't have money. So the board forecasted operating profit for the next 5 years as follows, based on a turnaround strategy implemented 6 months ago. So they have operating profit 6.1, 7.3, 8.0, and then we have operating cash flows. Then bank loan interest commitment. So the existing bank loan they have, the interest commitment are this. And the principal repayment of the bank loan is also this, as we have it. So clearly you see that beyond 2025, they don't intend to have the bank loan. And we're told by 2025, they should be done paying. So it tells you that the outstanding value of the loan is actually 2.5 million because they need to repay 1.2 and 1.25. 1.25 and 1.25, so 2.5 million is outstanding. Beyond that period, they are not paying again. Now, so the point is this. If you take operating profit, for example, if you back out this 1.25, the cash flows, the profits still look healthy. In fact, if you take operating cash flow instead of operating profit, and you back out the loan interest commitment and principal repayment out of it, you still have something healthy, right? Now, but you realize that how are they going to accumulate this cash flow said that they will pay of this face value of 20 million? That creates concerns. Now, so the board's option for bond restructuring. Let's look at it. The board is considering negotiating the terms of the bond indenture to address the imminent maturity of the bonds. Now, let's continue. However, the trustees are hesitant about extending the maturity date beyond 2 years from the original maturity date. So we know that 1 year is left for the bond to mature. They don't want to extend it beyond 2 years. The trustees, the bondholders, trustees that are working for the bondholders or representing the bondholders saying, even if you extend, it won't go beyond 2 years from now. So meaning they can only add 1 year to it, maybe upon consultation with the bondholders. The proposed options for restructuring include the following. Extending maturity date. So they are requesting an extension of the maturity date beyond the current 1 year. Okay. Then the second option is that they want to transforming to zero coupon bond. They want to transform the bond to zero coupon bond. So they will not be making coupon payments. So they will not have strains on their cash flows now. That is converting the bond to a zero coupon bond to relieve immediate cash flow pressure. The third option is that, which is a combined approach, they want to explore a combination of extending a maturity date and transforming into a zero coupon bond within the agreed limit of 2-year extension. Complicated matter. This is what they want to do. The existing yield on the bonds remain the same unless the transformation to zero coupon bond. It means that if the transformation happens to zero coupon bond, then this yield will change. Now, some of the bondholders have agreed to a conversion of their principals amounting to 7 million at maturity to equity. If this happens, if you see, they have about 20 million to pay at maturity. Some that have up to 7 million, says that, well, we have agreed to convert ours to equity, meaning their headache should be on how they can pay the 13 million, right? The company wants to achieve a debt service ratio and interest coverage ratio of not less than 1.5 and 2, respectively, over the forecast period with the restructuring program. The company wishes to achieve a debt service ratio, and I think that is what I've just talked about. So it also has a gearing ratio target of not more than 50% by 2028. Applicable corporate tax rate is 25%. Advise the board on the most feasible debt structure that will help it achieve its strategic financial objective. That's too much of work we can do today. So it's going to be part of the case studies we are going to do next week. Next week is the end of the program. So we'll do some modeling, and a similar scenario will be found in that model of the industry we are going to treat. Now, so you can try your hands on it. Now, let's just look at the last thing, then we are done for the day. That is debt modeling for valuation cash flows. Now, so if we deal with business valuation, are we going to do the debt modeling the same way? And the answer is the same approach, but different values. Now, what do I mean by that? There are two areas that are going to be different. So we need to compare traditional cash flow modeling versus valuation cash flow modeling. Now, if you are just doing cash flow projections for a bank or for the capital markets, maybe in some cases, maybe to raise funds, but then once it has to do with valuation, things are going to be a bit different. Now, so traditional, for interest rate used in amortization, you have to have a different interest rate use, not the one you use for the cash flow projections, just for planning purpose or whatever. But the market value of the debt, or the value of the debt you use on which you calculated your interest expense and all that, will also be different if this valuation works. Now, let's take the interest rate one first. For the interest rate used in amortization, now traditional financial projections, that's what we've been dealing with so far, is the traditional financial projections. It often uses current interest rates for debt amortization, reflecting short-term and outdated cost of borrowing. So the whole idea is this: whatsoever the interest rate is, as per the loan document, that's what we use. That's what I've been talking about all this while. For amortization, according to the loan documents, according to the facility letter, according to the loan agreement, according to the term sheet, the interest rate is 8%. Whether the loan was agreed 20 years ago or whatever, interest rate is 8%. That's what is used. But if you are doing capital market valuation, it doesn't work like that. For capital market valuation, that bond or that loan must be amortized using a cost of debt, not the interest rate in the terms on the term sheet or anything. It must be the cost of debt. That may be different from the interest rate in the term sheet or the facility document. Now, I'm not coming to treat cost of debt, because cost of debt must be treated separately when we deal with valuation. To treat just discount rate, which is cost of capital, right? Cost of debt, cost of equity. I'll require like 8 to 10 hours to teach that. That is beyond the scope of what we're doing. However, KPMG, I think we'll be doing one training on business valuation somewhere, I think in the month of August or something. And when the flyer gets out, you can participate. All these matters will be covered. Now, when it comes to the market, the value of the debt on which you calculate the interest or you repay, the value of the debt cannot be the value of the debt historically on the balance sheet. So, like in traditional projections, if a bank took a loan, let's say a year ago, 2 years ago, and the value of the debt currently on the balance sheet is 20 million, that 20 million is what we amortize, like what we've been doing. But however, when we do capital market valuation and we are doing cash flow analysis, you are projecting a cash flow for the purpose of business valuation. That value of debt on the balance sheet is not what we use. It's not correct. Think about it this way. The value on the balance sheet is actually an amortized debt amount. It's amortized based on interest rates used in the past. And since we said we are not using the interest rate and we are using cost of debt, then we can rely on that book value of debt on the balance sheet, because that book value of debt was based on an amortized amount or amortization carried out in the past, and that assume that historical interest rate, right? So it becomes unsuitable for valuation cash flow analysis. This is very, very important. These are important points you need to take home, even if you've not learned anything today. So what do we then have to do? Now, bank loans and bonds or whatsoever, we need to be able to determine their market value. What is the market value of the bond? What is the market value of the bank loan? And you may be wondering, what is market value of bank loan? It doesn't make sense. Yeah, we need to get an approximate measure of the market value of bank loan and the market value of the bond. Now, if it gets to, before we even talk about it, which is like some 2 slides to, I think I'll leave with some 2 slides to complete this, we need to know, for the purpose of valuation, what is debt? How do we consider debt when we're doing business valuation on a balance sheet? Number one, I defined debt earlier, but then all interest-bearing debt are debt, whether bonds, short-term loans, long-term loans, finance leases, they all meet the criteria of debt, whether short-term loans or whatever. Very important. Account payables and supply credits, they come close. The point is this: because suppliers can grant discounts for early payment, if you delay in paying, you will not enjoy that discount. So it means there's form of an implicit interest rate in the value of the payable. Because if you pay early, you have enjoyed that discount. The reason why you are not enjoying the discount is because you delay. So there's some kind of like an interest rate, some kind of like a cost to the company, an opportunity cost, right? If you are ready to make that implicit interest rate explicit, then account payables and supply credits must also be added to debt. Underfunded pension and healthcare obligations. And these can only be added to debt if and only if there is a legal requirement that you must cover the underfunding with a fees payment in future years. Then we reclassify that also to the debt bucket. So you create a bucket of debt and moving the things in there. Operating lease should be considered one, since it has become a commitment the company has made. So that must also be part of debt. You see the definition of debt. It's not a straightforward thing. That's why even in transactions, in the sales and purchase agreement, the SPA is defined in there what is net debt, what is cash. They are all defined in there. What is working capital level? What is a normal working capital? These things are all defined in an SPA agreement. Whenever we're doing transactions like sales of a company or a purchase of a company and all that kind of stuff, right? Good. One more slide to go after this one. How then do we calculate the market value of debt? Now, there are two cases that we can deal with. There are two cases. Now, the case one is that the company in question has only traded bonds as debt. Now, so if the company has only bonds that are trading on the market as debt, there's a way to handle them. In fact, that's simpler. Now, so what we do, if the bonds are traded, then the market value can easily be estimated by discounting the bond's future cash flows at the YTM of the bond. There are proper ways to valuing bond. Of course, the historic YTM may not be an appropriate way to handling it. That's why when you pursue the CFA program, at level 2, you'll be learning things like interest rate models like VASICHEC, the Holy model, the CRR model, which is the Kossinger-Ross model, and the Hall and White 1, Hall and White 2. Those goes beyond the scope of the CFA program. When you learn those interest rate models, the reason is because the interest rates at the rate or the initial YTM may not be the rate you achieve going forward. Market rate changes. So you have to simulate the possible path interest rate may change. And that's quite a lot of work. We don't need to get into that to achieve that, at least for now. So you get a YTM, you discount the future bond cash flows to today, you get a price of the bond. Easy. But the second situation is where the problem is. The second case is where the company has untraded bonds and other debt items. For untraded bonds, you can find a way of still, discounting some cash flows, blah, blah, blah. But when we deal with bank loans, yes, we have problem, especially bank loans. But even untraded bonds, especially bank loans, there's a way we can handle bank loans and those untraded bonds and all that. You do the same like the way we do basic bond math, the bond pricing math I talked about in case 1, which you can read about bond pricing math, where we just discount bond cash flows back to today. But this is all you do. You replace the coupons by the total interest expense reported in the P&L. So if you are calculating the market value of a bank loan, so you replace the coupon by the total interest expense reported on the P&Ls. So that becomes your coupon payment. So you look at the historical interest expense paid, and that becomes your coupons. You enter them as your coupons. Then you replace the tenor of the bank loan by the average maturity of the debt. What I mean is that what is entered in as a tenor or as a tenor when you are doing bond analysis, that is, in this case, that is the average maturity of all the debt. Like you put all of them together, the loans, the leases, and all that. And then you replace the face value of the bond, like the way we do bond math. You replace what you enter as face value, you replace it by the book value of the debt on the balance sheet. What is the balance sheet value of the debt? And then you replace the YTM, the yield to maturity, by the pre-tax cost of debt. Which I told you that you need to use cost of debt. You compute it. Then with that, you can calculate the price. Because now you have the future value, you have the interest rate, you have the tenor. So you can now calculate, and you have the coupon, right? So you can now calculate the price of the bond. The price of the bank loan. That is the market value of the bank loan. Right? Good. And based on that, you can now do your debt modeling. You can now do your debt modeling based on the market value and based on the cost of debt. The cost of debt represents the interest. The market value now represent the principal. I see. So there's one last question here. You can try your hands on it. It's on calculating market value of debt for Fly High Airlines, headquartered in Norway. And so if you have any question, I can resolve that in a class next week. Next week class will not be too long. Today, just a whole lot of things I need to cover. That's why the class kept long. I apologize for this. Thank you very much. And any question? Let me see the people who are able to stay with me to the end. Wow. Seeing you guys. Thank you very much for being with me, for listening to me the whole of today. You have a lot to do, but then you've kept the pace. Thank you so much for coming. And is there a question? At least say something. I want you guys to say something, and just to close this. So it doesn't look like I just spoke the whole day. Tell me something. How did today go? At a point, I have to rush. We are together to the end. Yeah, why don't we use the year? Okay, we are today. Please explain debt financing in a layman's term. Thank you. Thanks so much, boss. Thank you to very insightful. Thanks, Julius. Great session. The session is wow. Thank you. Thank you so much, Julius. Thanks, Julius. This session was really informative and insightful. I presume the weighted average maturity of our standard bond. That's what I wanted to say. Thank you very much, Benjamin, for that correction. Looking forward to business valuation. Yeah, KPMG will be organized 1, 2. So, but it's a paid version, trust me. But then you enjoy it. Thank you so much. Best lecture. Thank you, Anthony. I need more people. Those who have not spoken the whole of today, say something. Say something now. Let me just get something from you. If you know you've never spoken. Oh, no, that's why I think I saw you. So I think you typed something today. Thank you very much. Learned a lot. Looking forward to going over the slides. Great. That of KPMG, please. So do well to share on your LinkedIn. Definitely. Thank you. Good lecture. Thank you very much, Daniel. Let me see. Wells, thank you so much. Thank you. Thank you, Julius. Thank you too for the session. And we're meeting next week, Saturday, for the last side. Okay, no, before leaving, I want to say that before leaving, which industry would you like me to cover when it comes to the case study, the big modeling we'll be doing next week? Because if you share with me, I'll be sharing the case study 2 or 3 days to the meeting. I think 3 days to the meeting next week, next week, Saturday, so you can try your hands around it. So where we put everything together and do some cash flow analysis. So which industry would you like to make it cover? So I want to have the one that, okay, agriculture, telco, okay, banking sector, banking, agriculture. Let's do anything but not bank. Oh, banking. I want the banking people coming. You do not bank. Anything not bank. Not banking, okay? Agri telecoms, healthcare, okay. What else? Definitely not banking. Fund manager first. If they say not banking, I believe people don't even like the fund manager side. Real estate, hospitality industry. I want to see the industries. So we discussed to see which one we focus on. We'll build an end-to-end model for this. We can do extra week and add banking. Yes, it's something which we can do. So that will be a standalone. Will be a standalone modeling. Will not be part of this. I thought through this. Felix, I think we are on the same page, right? I thought through this, and it's something which we can do. We can do 1 more week, but not in this session. We can put that maybe in July. We can do that in July. That I'll discuss that with the CFA Society. And look, a big shout out to Efree for being here, for doing this. Why wasn't this paid? Why wasn't it? No, yeah, this one isn't paid. It's not a paid service. It's free. Oh. Guys, this is free. This is free for you. So it's not a paid service that we are rendering to you. Should have been paid. Oh, look. See. I get it. I know. But don't worry. This is part of our corporate social responsibility. So much work, right? But this is part of our corporate social responsibility as a society. So it's top value. We are grateful. Great. We are grateful too. We'll find a time, maybe in July, to do the bank modeling, right? God bless you all for putting this together. Thank you too. And is there a certificate for the program? No. I doubt if there is one. So of course, we will have this discuss, and I suggest manufacturing. Okay, Victor's suggesting manufacturing. I see. Thank you all. Thank you for your patience. At least about 33 people online, right? That's a great one. And I want to say have a great evening, and let's meet Saturday. Bye.